Good evening, everyone. So that's going to be another important session for us over the next 3 hours. We're going to talk about financial reporting and analysis. The weightage goes up to the maximum weightage goes up to 17% in the exam. So we expect to see around 30 questions in the mornings in the first section of the exam coming up on FRA alone. Just again, another reminder, I'm sure you know by now, I mean, both sections have got specific topics that are going to be tested in the morning and then in the first section as well as in the second section. In the first section, you are going to see questions on ethics, and financial reporting and analysis, quantitative techniques, and economics. So these are the 4 topics that are going to get tested in the morning, and then by today we are kind of done with 2 FRA and ethics, which are kind of over 35% of the topic weight. And so, I mean, it's needless to say, in the first section, you are pretty much going to do a test on ethics and FRA, because most of the questions are going to be pretty much, I mean, out of the 90 questions, you know, you're going to see roughly about 65 questions coming only on ethics and FRA. So FRA is again very important. You know, you try to score at the top notch on ethics and FRA. You know, that's kind of, you know, puts you on a very good competitive edge compared to the rest of the candidates sitting for the exam. And that's one of the reasons, you know, I always emphasize on, you know, FRA, because this is kind of something very, very important. Right, so let's get into the mind maps. You know, let's see how fast we can run through the mind maps. And what I'm going to do is basic slides, you know, I'm going to just run through, spend very little time on them. But if anything very important I want to say, I'm going to make a point. If not, we're going to move on and leaving more time for those difficult slides or kind of very important ones. I mean, financial statement implications for using different inventory valuation techniques and the implications of capitalizing versus expensing on various ratios. Some of those concepts like valuation allowances in deferred taxes, or how you can, I mean, how do you use LIFO reserves to arrive at FIFO inventory, etc. I'm going to spend more time on some of those technical stuff, and then I have chosen some questions to discuss with you. And if you see the review question workbook, there are about 124 questions are out there on FRA for you to try out. I mean, try all those questions out before you sit for the exam. You know, they are like kind of very good questions. I would probably tell you that, you know, most of the questions there are exam standard, you know, whatever the questions that you have previously done. The mock exam that I have given you on kind of FRA is like kind of probably not the latest one, but the before ones are like kind of more lengthy ones. But then, you know, in the actual exam, I don't see you get very lengthy FRA questions as such. So questions that are going to come in are pretty much going to look what we are seeing here, but you need to exactly know the concept to answer, right? So let's get, you know, going and see like if we can get through the materials in 2 hours or so, and then get on to those review questions. All right, so here you go, the slides. The mind maps. Right, so this is basically financial reporting and analysis. We are in this particular slide. Right, so basically introduction to financial reporting and analysis, and introduction to financial reporting standards. And as we know, the objective of preparing financial statements is to provide information to various users of financial statements in making decisions regarding companies. Whether the decisions could be to invest in the company or giving credit to the company, or it could be an analyst trying to evaluate whether to issue a buy recommendation or sell recommendation on the stock. So there are various interested parties who will be looking at financial statements in making decisions, and that's the role of financial statement. Now the problem is here is that financial statements can only provide you kind of a post-mortem of what has happened in the past. But the most important thing is to look at these financial statements, understand the current performance and position, and you should be able to forecast companies' future financial statements based on the historical information and other information out there in making economic decisions. So that is very important to understand. And this is important. I see in most of the exams, there's always one question coming up on the financial statement analysis framework. So what are the steps involved in analyzing financial statements? You have first, you understand what is the purpose of your analysis. What are you trying to do? Collect the data, collect all the data that you want to collect. P&L, balance sheet, annual report, what sources of information you want to collect data. Processing the data is like whether you perform a ratio calculations or whether you are doing a common size analysis or whatever you try to do, they're all processing the data. Analyzing and interpreting data is like comparing one ratio with another, trying to see what's going on here. Is there any relationship between one ratio to another? How do you understand it? Is it a good indication or bad indication? And that's analysis and interpretation. And then you develop conclusion whether this company is a good investment or not a good investment. Is this company's financial risk is high or financial risk is low? Any form of decisions that you want to take, you're going to develop conclusions and recommendations based on that. And then you continue to monitor, follow up, and this is the steps involved in financial statement analysis. So pay attention to that. It might sound very basic and straightforward, but there can be one question getting tested on that particular area. On the audit, I continue to see, when I look at your mock exam performance, is that there's some confusion on audits, like kind of, some of you continue to not get that one question getting tested on the audit correct all the time. So that's, one of the things that you need to remember is that auditors, they are not responsible for preparing financial statement. They only provide an opinion, and that opinion can be unmodified, clean, unqualified opinion, or qualified opinions. Qualified opinions means there is some problem with the accounts. A qualified adverse opinion, disclaimer of opinion. Disclaimer of opinion is that, you just don't have enough information to do the audit. So, you are, reserving yourself from forming an opinion. So that's disclaimer of opinion. Lack of information prohibits you from forming an opinion as an auditor. And one more thing, in terms of the differences between US GAAP and IFRS, this is something which is very important, is that, in US GAAP, auditors are expected to provide an opinion about a company's internal controls. And in IFRS, such requirement does not exist. And that's why you say, there is something called Sarbanes-Oxley Act in the United States, which was introduced after the collapse of Lehman Brothers and collapse of the financial crisis 2007, 8, 9. After that period, this act was introduced, and all US listed companies have to follow that. And that as part of that act, auditors need to provide an opinion about internal audit of the company, the effectiveness of internal audit. That's something very important in the US GAAP, but not an important requirement in IFRS. A very important slide that way. Moving down to, this is like something that I don't want to really spend a lot of time about. Income statement, balance sheet, statement of cash flows, statement of stockholders' equity, what goes in there. And one thing that I always tell people, I mean, this is kind of a possible confusion that come up. What goes into your OCI, other comprehensive income? Remember, any unrealized gain or losses as per relevant accounting standards can go into your OCI, like mark-to-market gain or losses on AFS, available for sale investments in the United States, that goes into OCI. Fair value through OCI in IFRS, gain or losses are taken through OCI, that goes in there. Foreign currency translation adjustments, any changes on your foreign currency reserves are actually adjusted through OCI. There are various adjustments that go in there, but it doesn't mean that you take in dividends as an outflow in your OCI. Many people actually go wrong here. Dividends, they are part of statement of changes in equity, a deduction from retained earnings. It is not going to be there. Any new share issues, any share repurchases, and anything to do with your balance sheet other than your gain or losses during the period are not going to be part of your comprehensive income. So remember that it excludes share issues, buybacks, and dividends, and they are only going to be there which in your statement of changes in equity. Now, one more thing I wanted to realize is that what goes into your income statement will come into your balance sheet as retained earnings. I'm sure you know that, retained earnings. And anything that goes into your OCI will also come into your equity in different reserves. Like you can just have one common reserve called OCI reserve, or you could have multiple reserves like fair value reserves related to AFS, foreign currency translation reserve relating to your foreign currency subsidiary adjustments, like, or it could be just one reserve you can call them OCI reserve, right? So that's something that you need to remember. Anything that goes into P&L will come into statement of changes in equity. Anything that goes into your OCI comes into statement of changes in equity. Dividends, share exchange, everything comes into your statement of changes in equity. Statement of changes in equity is going to be a reconciliation of your opening components of equity and closing components of equity. The movement in retained earnings is the movement from your income statement, your net profit gets carried forward into your balance sheet retained earnings, and then you deduct dividends from that. From the OCI, any movement, any changes shown in the OCI will get added or deducted in the respective reserves in your statement in changes in equity. For example, revaluation reserves on fixed assets in IFRS, increase or decrease in the reserves are adjusted through OCI and then reflected in the statement of changes in equity. So remember that, that's important. And one more thing on the statement of comprehensive income. So when you say comprehensive income, OCI, what are the difference? When you say comprehensive income, that includes income statement and OCI. But when you say OCI, it only includes OCI. So OCI starts from a figure. What is that figure? If someone wants to answer this question, when you are preparing other comprehensive income statement, what's going to be your first line in your OCI? How do you start your OCI to arrive at your final total comprehensive income? If you want to come up with total comprehensive income, that's your objective. Your objective is not just OCI, but then you want to understand your total comprehensive income, which includes your income statement as well as other comprehensive income. So at the beginning of your start of your OCI statement, how are you going to start your statement, and then what are you going to end? Anyone wants to answer this question? What is going to be your start? In your other comprehensive statement, you're going to start with some number, and then you're going to add and deduct few things relating to OCI, and then you're going to get something called your total comprehensive income. Total comprehensive income is what will be there as part of your statement of comprehensive income, but what would be the start for you in your OCI, other comprehensive income statement? What is your starting point? That's exactly right. You're going to start off with your net profits, net income. The net income that comes on to your income statement, that's going to be your net bottom line, will get carried forward into your OCI, and then you are going to have add or deduct something there, all your OCI elements, and then you have total comprehensive income. So remember, the total comprehensive income will have two components to it. One is net income and the other one is OCI. Remember, that's very important. And now I have one question before we move on to the next slide. Where do you think this total comprehensive income will get carried forward into your balance sheet? In your balance sheet, do you take your total comprehensive income into the balance sheet, or you don't take them? And if you do, where do you take the total comprehensive income? Yeah, where do you take your total comprehensive income into your balance sheet? Would you take them into your balance sheet, the total comprehensive income, including your net income and then the changes in your reserves during the period? Are you going to take all of them into your equity? Yes or no? If you're going to take them into equity, in which line are you going to take them? Are you there? How are you going to account for them? Where are you going to take your net income? Are you going to take everything to retained earnings? Is your total comprehensive income going to go into retained earnings? Is that right? What goes into retained earnings? What goes into retained earnings, guys? What goes into your retained earnings? Is it total net income goes into retained earnings? So remember that. Net income goes into retained earnings. Remember, total comprehensive income does not go anywhere as a direct addition, because you have the net income that wasn't distributed goes into retained earnings. So you add the whole net income to retained earnings and then deduct the dividends. That's what you do, and then you have your closing retained earnings. But all the other elements, like in the OCI, like revaluation reserves, fair value reserve, or foreign currency translation reserve, pension liability adjustment, everything will go into the respective OCI lines. Exactly, that's exactly right, sir. The OCI goes into other reserves as part of equity. So your total comprehensive income is there in your balance sheet equity in different lines. Net income is there in your retained earnings, and all the other reserves are there in respective reserves, or you just have one common reserve called OCI reserves. Remember, this is very important. You understand this foundation of the relationship between your total comprehensive income and then the balance sheet. That's very important, right? And then this might be something of interest to you. Look at this. In IFRS, they may combine with comprehensive income, so they don't separately publish in IFRS separate statement for income statement and then total comprehensive income. They just have a total comprehensive income, and then they have income statement, they have net income, and they start immediately OCI, and then they say total comprehensive income. So total comprehensive income, don't forget, includes income statement, which includes the net income for the period plus the total other comprehensive income for the period, making up the total comprehensive income, which can be combined in IFRS, but in US GAAP, your statement of income statement should be separate and your comprehensive income should be separate. Something that you need to remember versus in IFRS and US GAAP differences. Going further down into, I don't want to spend a lot of time here. If an international accounting standard board called issues IFRS accounting standards, which are globally adoptable accounting standards, but in the United States, Financial Accounting Standard Board, we call them FASB, is responsible for issuing US GAAP in the United States. But the problem is, although International Accounting Standard Board has achieved a good amount of success in implementing their accounting standards globally, in the US GAAP, still they are using US GAAP, and there are significant differences between US GAAP and IFRS, which we are going to see throughout the study session. Right, moving further down, something very important in this particular slide is that, look at this particular bit. I'm going to focus on this particular bit here more than this bit. You can always have a look at them and look at this particular bit here. I'm going to spend a couple of minutes there because there could be probably some questions getting tested there, and that's kind of always of the interest of the examiner. So let's focus on that. And before that, just to tell you, these mind maps in FRA, if you have already studied FRA in the slides, then these are kind of more concise version of the slides, covering almost all the most important LOSs. It is not comprehensive, but it is a very good revision for you to revise them and see if you know things. I mean, if you see here, okay, you don't understand something, okay, which means you will have to revise back your detailed slides. But if you know this, if you are able to explain to yourself what these things are, and then that kind of tells you that you are in a very good shape. And that's why I really like these mind maps. They're just wonderful, and they do the job very well in the last 2 weeks in your preparation towards your exam. Right, so qualitative characteristics of financial statement. There are two major qualitative characteristics. One is relevance. You are providing information to the users which are relevant for decision making. Faithful representation means your financial statements are reliable. They are complete, neutral, free from material errors, and that's what faithful representation. So look at relevance and faithful representation, and then they say enhancing qualitative characteristics are comparability, verifiability, timeliness, and understandability. You got to know this bit. So you pay attention here, you got to remember them. That can probably be tested in the exam. What is the constraint in achieving your qualitative characteristics, achieving your timeliness or comparability? The problem is there is always a trade-off between verifiability, or you can call them reliability. This is pretty much the same thing. I don't see anything that, there's a big difference between those two. Verifiability or reliability and relevance have a trade-off. Why is that? If you want to provide financial statements as fast as possible, timely information, you want to be relevant. You want to give information to the users very fast. If your year end is 31st of December, you want to report your financial statement in a week's time. But if you try to do that, maybe you might not be able to carry out all your verification process. So reliability of your financial statements might be put into question. So that's what we always say. There's a trade-off between reliability and relevance, or verifiability and relevance. So that's something that you need to always look at, and you have to always look at the benefits of providing information to the users exceed the cost associated with them. That's very important to look at it. And also remember, the constraints of financial statements is that it excludes non-quantifiable information. Financial analysis is just one part of analysis. There's a lot of other decisions, other factors that you need to look at, the governance issues, how the company is managing itself, and CSR issues. How do you understand them? So that's again another constraint in financial statement framework. Going further down, you know assets and liabilities and equity in the balance sheet, and income and expenses in the income statement. When it comes to assets, the most important terms to look for in the definitions are assets which are resources controlled by an entity as a result of past event which provide you future economic benefits. So term control is very important. You don't have to necessarily have the legal title relating to the asset. You just can control them and still recognize in your balance sheet. Liabilities are obligations as a result of past events which are going to lead to economic outflow when you are settling them. Equity is your net worth at any given time. Assets minus liability is shareholders' interest in the business. And then if you look at on the other hand, so when you talk about equity, I always want to tell this to you guys. Remember, irredeemable preference shares. So what do you mean by irredeemable preference shares? Preference shares, they are they do not have a maturity. How would you classify them in US GAAP, and how would you classify them in IFRS? So that's a question. I open it up now. Can you guys answer? How do you account for irredeemable preference shares in the US GAAP, and how do you account for that in IFRS? Okay, how do you in IFRS, how do you account for them in as debt? What about in the US GAAP? How do you account for irredeemable preference shares in the US GAAP? How do you do that in the US GAAP? Irredeemable preference shares, pay attention to that. The preference shares which do not have a maturity period. How do you account for them in the US GAAP? Do you treat them as an equity or debt? Remember, that's exactly right. In the US GAAP, irredeemable preference shares are accounted for as equity, not debt. But in IFRS, both preference shares, redeemable and irredeemable, are accounted for as debt instruments. So whatever that you pay goes into your as financing cost in the income statement in IFRS. But in the US GAAP, if you have redeemable preference shares, that goes into debt, and the interest relating to that will go into your income statement. But if you talk about for irredeemable preference shares, that is adjusted in your balance sheet statement of changes in equity, because irredeemable preference shares are part of your equity in US GAAP. So don't forget that. That's very important in this particular slide. And so on the P&L, you have income and you have expenses. And then if you want to talk about OCI, then this is purely P&L, income statement. And then you have your OCI, unrealized gain or losses. So this sheet is final for P&L and balance sheet. Moving further down, okay, this is a typical pro forma income statement. What you should be looking at from in this particular format is that, do you have any, pay attention to key points. GP margin, that tells you whether a company have enough profits at GP level to pay off your expenses, your interest, and your taxes. And then you have something called your operating profit. Then what is your operating profit? We call them EBIT, EBIT, where you deduct your operating expenses and you get your EBIT. And then Remember, in your EBIT, the problem is it has amortization and depreciation, which is non-cash. So there is an interesting measure that we use is EBITDA, which is before depreciation and amortization. You take EBIT and then add back the depreciation in COGS or in OPEX. That's going to give you EBITDA, and then you have other expenses, other income, financing cost. All of them come in here. Your financing cost comes in here, and then you have unusual or infrequent item. As an analyst, you should forecast that. So you should analyze that and look at, sorry about it, I said you should forecast that. No, you cannot. There is some line which is very hard for analysts to forecast because it's one-off, but you need to analyze what's causing that, remove that from your analysis to normalize, get a kind of a decent number, because this could include impairment charges, this could include restructuring cost, it could include some gain or loss on sale of some large assets that can distort the core performance of the company. That needs to be adjusted. So that's the unusual adjustment. And then you have your taxes. These taxes includes the taxes payable in the current period because you made some profit. And remember, that also includes any changes on your deferred tax assets and deferred tax liabilities. We'll talk about them as we go down. So that's something very important to remember. Okay, now I'm going to ask you a question. If a deferred tax asset is increasing, what would happen to your income taxes in the balance sheet? It's a very important question. That's very useful in understanding your taxes as we go further down in your material. So what do you think about it? If deferred tax asset is increasing, your DTA, if you want to call it that way, if an asset is increasing, it doesn't have to be a deferred tax asset. That's exactly right. It's a perfect answer. That would reduce your income taxes. That would reduce your income taxes. So when that reduces your income taxes, what would happen to your net income? Your net income will go up. So this is something that you've got to remember. This is very important. If deferred tax asset is coming down, your income taxes go up, would reduce income taxes. Similarly, if deferred tax liabilities is increasing, what's going to happen? Deferred tax liabilities are increasing, what would happen to your income tax? Your income tax is going to go up, and then your net income is going to come down. And that's, you need to know. So income tax here has got three elements to it. One is the income tax for the period, and then movement in deferred tax assets and movement in deferred tax liabilities. Think about that. And what about this discontinued operation? This discontinued operation is relating to a business unit which a company or a subsidiary, a company has classified as held for sale during an accounting period, but it has either sold it or not yet sold. So any net income resulting from the operations of that particular business, right, should be removed from all your line items in the income statement, shown as a separate line, and that's where you see discontinued operations coming up. And remember, if you are changing accounting policies or presentation of financial statement, your prior period income statement and balance sheet needs to be restated. Look at this. Prior year comparative is adjusted for changes in accounting principles. Moving further down to the next slide. Okay. Revenue recognition. How do you recognize revenue? This is a new accounting standard, IFRS 15, revenue recognition, which is aligned with US GAAP pretty much. So that's a major task. These two accounting bodies, IFRS and the US FASB and IASB, work together to come up with a common accounting standards here. And so there's a 5-step methodology of recognizing revenue. You need to know those 5 steps. You always can revise them. That's very important to look at. You need to identify a contract with the customer, understand what the contract is for, what are the performance obligations in the contract. You need to identify the performance obligations, meaning what the seller has to provide to the buyer. Number 3, determine the overall transaction price. And number 4 is allocate transaction price to the individual performance obligation. And remember, the most important point which is testable here is that you need to remember that you recognize revenue when a performance obligation gets completed. So focus on that. That's very important to understand. You recognize revenue on when the performance obligation gets completed. And in long-term contracts, you recognize revenue based on the degree of completion, and the degree of completion can be calculated in 2 methods. One is output method and the other one is input method. So in the input method, we divide the total cost incurred to date divided by the total estimated cost to identify the degree of work completion in input method. In the output method, probably your site engineer will have to confirm what is the percentage of work that is done. And something more I want to say before we move on. When you are acting as an agent in a consignment situation, you are giving your goods, you are a seller, you are giving your goods to an agent for him to sell to third-party customers. Remember, the agent will recognize only the commission income as a revenue. You will recognize the revenue as the total revenue less your commission income payable to the agent. The agent will only recognize the commission income. Obviously, that makes sense. I have absolutely no logical issues with that. Although they are selling on behalf of you, whatever they receive from the customer, they have to pay you. So why would they show the total revenue as revenue for them? They shouldn't be. That's why they only show the commission income, and you show the whole revenue net of commission expenses. Moving down to the next slide, understanding your income statement. I wouldn't really spend a lot of time at this point in time, because this is exactly I'm going to talk to you in long-lived assets, inventory valuations, and taxes as we go down. One thing that I can tell you is that what needs to, come to the attention of analysts, or analysts needs to be vigilant about certain things in the balance sheet, like, you have inventory valuation of the company. Are they changing from one method to another? Are they using LIFO or FIFO? What about depreciation? Useful lives, is the company changing the useful life from one year to another? Warranty expenses, bad debts expenses, are they changing these things? Are they changing revenue recognition policies from one year to another? These are some of the questions that you need to always ask when you're analyzing a financial statement, just to determine that there is nothing dodgy going on in the financial statement. Like, you see you don't want to write and make a fool out of yourself and you say company's profitability increased by 30%, and which is a good indication and things like that, and only to realize okay, this company has changed the inventory methodology, and that's why the inventory that is why it has caused the profits to go up by 30%. So if you understand what I mean, you need to understand what is driving the profitability. Is it the core performance of the company, or any of these changes in accounting estimates can contribute positively or negatively to your net income? As an analyst, you need to identify them, probably remove them, normalize your earnings. That's a very important thing to look at, and we will touch base on this slide as we go into the future slides as well. So going further down, you have your understanding of your income statement. We already spoke about discontinued operations, which is like the profit or loss from asset held for sale. And if you have classified a business unit as a held for sale, but you still haven't sold them, any net income will be removed from various lines in your income statement and shown as a separate line at the end called net income from discontinued operations. And this is the line you're going to show three items. You're going to show them the net income from the discontinued operations. You're going to show the impairment charges of that asset held for sale, if any, and gain or losses on disposal of asset held for sale. All these items, remember, will go into your discontinued operations line. And unusual items, we already spoke about it. You have to be always, as an analyst, vigilant about these big spikes, big volatility, increase and decreases in your financial statements, arising from non-recurring income, non-recurring expenses. Right. Now, this is very important. Changes in accounting policies. I mean, if you are changing accounting policies from one policy to another, good example for a changing accounting policy is changing your revenue recognition policies and changing from cost model to revaluation model, changing from LIFO to FIFO in inventories, or changing the presentation of your financial statement. You have included depreciation in COGS and now you are changing to your admin expenses. So that's all changes in accounting policies. What you need to do is you need to follow retrospective adjustment, restate the prior period financial statement if you are doing accounting policy changes. Estimation technique changes. For example, you are increasing the bad debt provisions, changing the salvage value of assets, decreasing the useful life of the asset or increasing the useful life of assets. They are not policy changes. Any changes in your deferred tax assets and liabilities due to changes in tax rates and things like that are estimation technique changes. They should be accounted for prospectively, meaning from now onwards. In your current financial statement, you don't need to restate and do a retrospective adjustment in the historical financial statement. And remember, prior period adjustment means that if you have any errors you identified incurred in the past, that needs to be corrected in the current financial period. When you are correcting it, you don't charge the current P&L. You have to charge that or recognize the revenue or expense depending on whatever it is. It needs to be done in the year and it was incurred. So which means restatement, retrospective adjustment, summary, policy changes, correcting prior period errors, retrospective adjustment, changes in accounting estimates, prospective adjustments. That's about that slide. Going down to the next slide. I'm not going to spend a lot of time. You need to know calculation of basic EPS, where your EPS is calculated net income less preferred dividends divided by weighted average common stocks. That's going to give you your basic EPS. So whatever you do, if you have stock split, or if you have bonus shares, if you have issued or repurchased shares during the year, you need to know how to carry out the calculation for weighted average number of shares. So remember, if you have any doubts, you can speak to me now, because that's kind of very important on basic EPS. If at all you are going to get a question on basic EPS, that question is actually going to focus on calculating the weighted average number of shares. There's no complications on the numerator. Numerator is net income minus preference dividends. If the preference dividend is not deducted in the net income, then you will have to deduct them separately. But the denominator, you need to understand how to calculate your weighted average number of shares when there is a stock split, when there is a share repurchase, when there is a new share issue at full market price. Make sure you know that. And then, what is diluted EPS? Diluted EPS is where you have a complex capital structure. What is a complex capital structure? And a simple capital structure, remember, a simple capital structure is something that you do not have a convertible instrument, or you don't have an options. If you have options and warrants, or if you have convertible instruments, that makes it a complex capital structure. That's how we understand Complex versus simple capital structure. Remember, this is tested. You can, something that you can always say. There will always be some questions coming up on EPS, either basic or diluted or both. So make sure that you know this calculation in and out. This is something that you can't afford to lose marks in the exam, right? So you need to know in diluted EPS, there are only 3 questions can come in diluted EPS. One, you need to know that it could be in the form of calculation. You have a convertible bond converted into equity, convertible preference shares converted into equity, and then you have share options. So these are the 3 things which you should know how to calculate your EPS. Most important thing is, if your EPS, diluted EPS, is more than your basic EPS, how do you call that? Can someone tell me? If your diluted EPS is more than your basic EPS, how do you call this? It is called anti-dilutive. So do you report, in that case, your diluted EPS? Would you report your diluted EPS if the diluted EPS is anti-dilutive? No. You report your diluted EPS only when it is lower than your basic EPS. Suppose you figure out that your diluted EPS is actually more than your basic EPS, you just say basic and diluted EPS are the one and the same. You don't want to, the objective is to provide a pessimistic view to the investor, not an optimistic view to the investor. That's the purpose of doing diluted EPS itself. So you don't want to really report something bigger. Yeah, so that's the idea here. Let's look at some questions in the review question on EPS. But this is your OCI. You see exactly, this is a question I asked. You have net income and the changes that goes into your OCI during the period, and then that becomes comprehensive income. And this is what I asked you, whether this comprehensive income goes into any particular line in your balance sheet. No, this net income goes to retained earnings, and all this goes into respective reserves, and total comprehensive income is just an addition of these 2. So why? And then you can ask me, why then comprehensive income? What is the purpose of it? This includes both realized gains and losses, unrealized gains and losses during an accounting period. That's what it is, right? And this is, and this is again one of the favorite areas of the examiner: operating and non-operating income. It is different for financial sector and non-financial sector. If you are talking about a financial sector, interest, dividends, and gain or losses and disposal of securities are normally considered to be core activities, operating activities. But for a manufacturing company, all of them are non-core activities. So something that you need to remember: interest income, dividend income, gain or losses on disposal of your securities will go in as your non-operating income. So if you have any questions or confusions, please raise it up now. Okay, moving down to the balance sheet, something, these are things that we are going to discuss them in detail as we go down. And remember, one thing that you need to know is that in the US GAAP, balance sheet is prepared based on most liquid assets to least liquid assets. So that's why you start with current assets, but in the IFRS, you start with the least liquid assets to most liquid assets. So liquidity-based balance sheet, which banks usually use, is similar to the US GAAP, but in IFRS, no, it is different, right? They start with non-current assets. So basically, something I will talk about investments later, inventories later, just that I don't want to repeat. So I'm going to go down further to the next slide. You have long-lived assets, understanding of the balance sheet. So we are actually still in understanding of the balance sheet. So something that you need to remember is that when you're talking about long-lived assets, which are your fixed assets, so you need to know that in fixed assets, there are various types of fixed assets. One is your property, plant, and equipment. which you land in buildings, you buy them and depreciate them, and over a period of time, depreciation method, straight line, double declining, units of production methodology. You know, most of the times I don't see in CFA they talk about reducing balance depreciation. So what they talk about always as the difference between straight line and double declining. Think about it. Straight line and double declining is what you need to know. Let's look at some questions later. Right, and then you have your securities, fair value through P&L, fair value through OCI, amortized cost. That's again long-lived assets, but remember they are financial assets, not non-financial assets. And you have investment properties. Investment properties, are they part of your US GAAP? Do you have a classification for investment properties in the US GAAP? What do you think about it, guys? No. So how do you account for them in the US GAAP then if you don't have a separate classification as investment properties? How do you account for them? Where would you put them under? Your investment properties, if you do not have a separate classification, where would that go into? It goes into PPE. Remember, that's exactly right. So it goes into PPE. That's right. Anyway, we'll talk about them as we further go down. And then understanding the balance sheet. Okay, this is interesting. This is important. You know, this is like probably the difficult topic for level 1 candidates, is that, you know, different treatments for different financial assets. We are going to talk about financial assets. I'm going to talk about just a summary, and I'm going to probably ask you most of this material as questions. Probably I expect you guys revise this so many times now. So I'm going to ask you now, in IFRS, there are 3 classifications of financial assets: fair value through P&L, fair value through OCI, and amortized cost. Now, the first question for me is that from me is that if you have a held to maturity bond where you are not going to sell your bond investment until the maturity, your objective is to collect the principal and collect the interest and the principal cash flow. Under these 3, which one you are going to choose? Are you going to choose fair value through P&L or fair value through OCI, or are you going to choose amortized cost? Are you going to choose? Which one are you going to choose? If you're going to hold your bonds until maturity and you are not going to sell them before, what are you going to do? Are you going to account for them at amortized cost, or fair value through OCI, or fair value through P&L? You're not going to sell them. If you're not going to sell them, why would fair value becomes relevant? Fair value becomes relevant only if you might sell them. Amortized cost, remember, held to maturity, you're not going to sell them. You buy a bond, it goes up in value, come down in value. How does it matter? It doesn't matter for you. Why? Why does it matter? Because your objective is to receive interest. At maturity, you get your par value. It doesn't matter whatever happens to your bond prices during the period. So you report your interest income based on amortized effective interest method in your income statement, and you just have to ignore the fair value changes. Okay, my next question for you is that if you are buying an equity securities in IFRS and accounting for fair value through P&L, I mean, what are the 2 items that can be part of the income statement relating to such equity investments? If you are classifying equity investments that you have purchased and classifying it as fair value through P&L, what are the 2 elements that would go into your income statement in relation to your equity investments, which you classified as fair value through P&L? So there are 2 items that can come into your income statement. What are those 2 items here? One is dividends, that's right. What is the other one? You're classifying it as fair value through P&L. So Dividend and the gain or loss on sale. There's one more. Okay, maybe I would say third thing. What is the third thing? You're accounting for an equity investment as a fair value through P&L. So dividend is fine. Gain or loss on sale is fine. There is one thing more that goes in to your income statement. What is that? In relation to fair value through P&L. What is that? What about the mark-to-market gain or losses? Where would that go into? You buy an investment for $10, a share for $10 that goes into 15, you still didn't sell them. How would you value them? Would you value them at fair value, or will you buy them at cost? You value them at fair value. So what would you do? The fair value change. The fair value change goes to income statement. So your income statement has mark-to-market gain or losses. Your income statement has dividend income, and ultimately gain or loss on disposal when you are selling them. Don't forget that. Right, and then fair value through OCI. Okay, now I have a question for you. What is the difference between fair value through OCI bonds and fair value through OCI equities in IFRS? I'm focusing on this particular portion, fair value through OCI bonds and fair value through OCI equities. What is the key difference between these two classifications? That can potentially be tested. I'm talking about IFRS. There's nothing much to talk about if you answer all these questions correctly, and then there's nothing much to talk about in this particular slide. What do you think you should do? What is the key difference between fair value through OCI bonds and fair value through OCI equity? What is the key difference? I mean, you buy these equity or bonds. Whenever you buy, the gain or losses, on mark-to-market gain or losses will go to OCI for both for OCI bonds and OCI equities. You don't take them to P&L. Once you classify equity through OCI, you can't change. Okay, that's exactly right, Bansi. That's a correct answer. Once you classify equity, it's an irrevocable choice. You cannot change them. But for bonds, you can change if you want. Change it to fair value through P&L, or change it to a amortized cost model. If your business models change, you could change, but equity, you can't change them. Anything else is a difference. What do you do at the time of disposal of these bonds and equities? If you dispose the bonds, where do you take the disposal gain or losses on the bonds? Where do you take the disposal gain or losses on the bond? You take them to income statement. But where do you take the disposal gain or loss on the equities? Where do you take the disposal gain or losses on the equities? Do you take them to income statement, or where do you take them? I'm talking about equity securities measured through fair value through OCI. Irrevocable choice in IFRS. My question is, at the time of disposal, the gain or losses on the disposal, where would they go into? Would they go into OCI? They go into OCI. Remember that. And do you reclassify your fair value reserve, your OCI reserves to income statement? No. But do you have to reverse that for bonds? Do you have to reverse that for bonds? Yes or no? Do you have to do a recycling of your OCI reserves back into your P&L when it comes to OCI bonds, but OCI equities? Nothing goes into your income statement except one particular item. What is that item that goes into your income statement? For OCI equities, I'm talking about. You are classifying an investment as an OCI equity. That's exactly right, Basil. That goes into the dividend income. The revaluation, which is the mark-to-market gain or losses on the equity investments, remember, they go into your OCI. And that's why we have this classification. Otherwise, the default category for equities is fair value through P&L. In the US GAAP, this is similar to trading securities. If you have a trading investment, fair value gain or losses will go into your P&L. And AFS in US GAAP is similar to fair value through OCI, but remember AFS choice in US GAAP is applicable for both bonds and equities. So in US GAAP, there is no irrevocable choice. If you are treating an AFS as fair value through OCI, the gain or losses on the equity securities and bond securities will be taken to OCI, but at the time of disposal, the gain or losses and will be taken to P&L, and there is a recycling of your OCI reserves into income statement for both equities and bonds in AFS in the US GAAP. But in IFRS, no, that's not the case. For bonds, yes, it's the same as AFS, but equity is like kind of treated in a peculiar manner. That's what you need to understand here. Held to maturity investment is amortized cost, no differences at all. Moving further down, there is nothing much I need to talk about here. Current assets, current liabilities, balance sheet, equity, pretty much basic stuff. Okay, this is very, very important. Statement of cash flows. There is an increasing emphasis in the recent days that people started to look at cash flow statements more than the income statement, because in the income statement you have a lot of non-cash items, non-cash items, so it doesn't really tell you the cash flow generated by an organization during an accounting period. So that's why the focus shifts to cash flow statement. So look at this. How do you calculate cash flow from operating activity? It's a good summary here. Your net income, you add non-cash charges minus working capital changes, that goes into your CFO. And look at these two. I mean, this is very important. Free cash flow to the firm. What you do, you take the CFO and add the interest, because in the US GAAP, if it is US GAAP, you add the interest back. But in IFRS, if the interest is already deducted in your net income, then you deducted. So if you then you have to add back your interest 1 minus tax rate, and you are adding back to your you're assuming that your CFO already after interest expense. In US GAAP, it will be always. So pay attention to what I'm telling. This is very important in your FCFF, free cash flow to the firm. We know free cash flow to the firm, is it before interest or after interest? First answer that question before we get into the details. What do you think about free cash flow to the firm? Free cash flow to the firm, is it before interest expense or after interest expense? Only thing that you need to know, free cash flow to the firm, not to the equity holders. It is to the firm, both debt holders and equity holders. So in that respect, it is before interest. That is fantastic. Free cash flow to the firm is before interest. Free cash flow to the equity is after interest. So free cash flow to the firm, you take this cash flow from operating activities. If it is US GAAP, your CFO, does it already include the interest paid? Think about that now. Interest paid is a cash flow from operating activities in the US GAAP, but interest paid is cash flow from either operating activity or financing activity in IFRS. So that's what you got to pay attention. If it is US GAAP, you have to add the interest 1 minus tax rate. But if it is IFRS and the interest expense are treated in financing activities, you do not have to do anything here. Hope you get that point. If you're a CFO, you're looking at an IFRS firm who is accounting for interest paid as a financing activity, then when you're calculating FCFF, you take CFO minus your CapEx, capital expenditure. You don't have to do anything. But if you're talking about a CFO US GAAP or CFO in an IFRS firm who's showing interest as a CFO, then you got to add back the interest 1 minus tax rate to make your cash flow before what? Interest expenses. So that's free cash flow to the firm. Free cash flow to the equity is basically you just take CFO, which is cash flow from operating, and then you have capex, and then do you have to deduct interest expense? I have a question for you. In FCFE, is it after interest or before interest? First question. Is FCFE, is it after interest or before? That's right, it's after interest. Do you have to deduct that separately for a US GAAP firm from CFO? If you're starting from CFO, do you have to deduct the interest expense for a US firm? It is already deducted, so you don't have to do anything. That's exactly right. But if it is an IFRS firm showing interest expense as an operating activity, do you still have to deduct the interest expense? I'm talking about an IFRS company. No, but if you're talking about an IFRS company who's treating interest expense as a financing activity, then you go and deduct. Then your CFO doesn't reflect that. Then you go and deduct the interest expense, deduct capex. Don't forget net debt increase. If your net debt is increasing from 1,000 to 1,500, that 500 increase is there for you to use as to pay dividend, although it's not a good practice to take loan and pay dividend. But in theory, if the debt is increasing, that money is available for use. For who? For the equity holders. And that's why we add your net debt increase. Don't forget that. So what if you are given FCFF? If you are given FCFF to arrive at FCFE, can someone tell me how to do that? You have FCFF. I'm giving you FCFF. How will you convert into FCFE? Can you tell me the two adjustments that you will have to do to your FCFF to arrive at FCFE? These are questions that possibly can get tested in the exam. So what do you think about it? What do you think about that? FCFF. If I'm giving you FCFF, free cash flow to the firm, okay, you are deducting the interest, adding the net debt increase. That's fabulous. That's exactly what you do. Right, so understanding cash flow statement, this is a good summary. In IFRS, interest received is cash flow from operating activities or cash flow from investment activities. IFRS gives choices. Always remember, in a multiple choice question, even if you don't remember what exactly the standard says, remember IFRS always gives you a choice, but US GAAP doesn't. So dividend paid, interest paid, options, cash flow from operating activities or financing activities. But in US GAAP, dividend paid is financing activities and interest paid is operating activities. Similarly, interest received, dividend received are in IFRS is either cash flow from operating activities or cash flow from investment activities, but in the US GAAP, you don't have a choice. It will be interest received will be part of your operating activity and dividend received will be part of investment activities. So there's like always prescriptive as to what you should be doing. And also this is probably one thing that they always test is in cash flow statements, overdraft is considered to be a cash and cash equivalent in IFRS, but not in US GAAP. Also remember that. So the movement in your overdraft will go into as your financing activities in your statement of cash flows in US GAAP, but overdraft movement is not shown on the cash flow statement for IFRS because they are adjusted in the opening and closing cash and cash equivalents. Remember that point. And then you need to know the direct method where you are showing the cash received from customers and cash paid to your suppliers separately in your operating activities. But in indirect method, you start with the net income, do all the adjustments to arrive at your cash flow from operating activities. So direct method and indirect method, if you talk about it, in terms of which is the best method of preparing financial statements from a user's perspective, in terms of providing better information, which one you think is a very good method, direct method or indirect method? Direct is very good. It provides more information, but unfortunately, it is not practical to do it, and that's why you see most of the companies prepare financial statements using indirect method in their external reporting. Okay, and the next question from me is that, next question is, what about operating activities and financing activities when you're talking about direct method and indirect method? Is there any differences? Is there any differences between direct method and indirect method when you are talking about your investment activities and financing activities, between direct method and indirect method? Or is it going to be the same? What do you think about it? No differences. And also, increase in asset is a deduction. It will reduce your operating cash flow. Decrease in the liability you add, and I'm sure you know this. This is something very important. It's a very good slide on cash flow statements, by the way. It's a good summary. Going further down, okay, the steps in preparing cash flow statements. I'm sure you guys know what to do and things like that. So I'm just skipping those two slides. Indirect method, direct method, how to prepare them. That's not really, I find it useful to discuss in a review session. Right, so now again, pretty much these are stuff talking about the details of your cash flow statement steps. That's pretty much fine. Okay, this is something very important. I would pause a while here and spend a few minutes before we move on to the next slide, because always there's an emphasis on this cash conversion cycle. What is cash conversion cycle? Always remember, cash conversion cycle is inventory days plus receivable days minus payable days. See how handy this particular mind maps. It gives you all the ratios just in one go. You just have to tick, do a tick and see, you know this, you know this, you know this. If you don't know this, just pay attention there. I'll tell you what is important. Cash conversion cycle is important. All these are very important. Payables turnover, inventory turnover, receivables turnover is important. Here, everything is important. So in this particular slide, I would think the whole slide is important. Current ratio, quick ratio, cash ratio, defensive interval ratio. You know how I remember? I'll tell you how I remember. Easy to remember. Current ratio is current assets divided by current liabilities. You don't do any adjustment. Just take your current assets, divide by current liabilities. But now that you realize current assets have got a problem. What is the biggest problem? What is the most illiquid assets in your current assets? Can you tell me? I'll explain the logic so that you don't forget it. Inventory. So you remove that, and then that becomes what? If you remove that, then that becomes what ratio? If you're removing the inventory from that, it becomes what ratio? If you're removing the inventory from your quick ratio, it becomes quick ratio, not cash yet. Look at it, cash plus marketable securities plus accounts receivable. You still have every component other than the inventory in current assets. That's quick. Now you still feel this is not so good enough. It is not so liquid because you got your quick ratio, the numerator includes something illiquid. So now tell me, out of these three, cash, marketable security, AR, which one is most illiquid? Which one? AR is most illiquid. Remove that, it becomes cash ratio. So you take your current assets, remove inventories, it becomes quick ratio, remove AR, it becomes cash ratio, most liquid measure in the balance sheet. Hope that is clear. And then, I mean, if you understand this, if you study this way, you don't necessarily have to keep so much in your memory as formulas, which I hate to do it in the exam. So this is probably a smart way of studying. And then, you know, defensive interval, again, something which is very often tested in the exam. Defensive interval ratio, what you do, the numerator is as same as quick ratio. So you don't only take the inventory. So it's current assets minus your inventories, or your cash plus marketable securities, which are liquid, and then your AR divided by daily cash expenditure. So that's going to show you how many days you can remain solvent if you don't get any more business. So you, let's say it's like you got $100,000 in your hand. No, not say $100,000 is that way too much. Let's say you got $10,000 in your hand and you need about $1,000 a day. Let's say you're living kind of a luxury life. You need $1,000 a day. And how long can you live without going to work? You can live 10 more days, isn't it? You have $10,000. $1,000 without earning any more money, you can live for 10 more days. And that's what defensive interval ratio. If you don't receive any more cash flow, whatever the cash that you have, including AR, but there's a problem. I would like defensive interval ratio. If you remove AR, it's like probably more stress testing. If you want to stress test a company's balance sheet, you remove AR, but they don't usually do it. So defensive interval ratio, you include AR divided by daily cash expenditure. That's going to show you your how many days you can run the business without defaulting or going into bankruptcy. And all these ratios are super important, so remember them. Not that I don't want to discuss them, but we just have lack of time, so I'm just moving on because I'm sure you guys know, but cash conversion cycle is super important. And moving down, okay, return on sales, your ratios, GP margin, operating profit, net profit margin, EBITDA margin, you know, you can go on. And these ratios are also called common size ratios, isn't it? Return on investments. When something is on P&L and something else is on balance sheet, P&L should be, the balance sheet should be average. Remember that. Hope you go back to our initial FRA classes. You know, if return on anything P&L and balance sheet is like P&L is, if one numerator is P&L and denominator is balance sheet, it has to be, balance sheet has to be average. But if both ratios are P&L, both ratios are balance sheet, both ratios are balance sheet, you can go with the ending and closing figures. Okay, you vertical common size, in P&L you divide everything by sale, in balance sheet divide everything by total assets. What is horizontal common size statements? You're going to divide each number in your P&L or balance sheet with a base year. Your base year is your base year, and you're going to divide everything by that times 100. So it's going to look like an index, like a CPI index. If you like it, if you want to put it that way, that's how it's going to look like. Okay, return on investment, you have your EBIT divided by capital employed, total capital. Return on equity, net income divided by average equity, and then return on common equity. This is kind of, you know, this ratio is not there in IFRS. Can someone answer this question? I just want to now at this point in time test your knowledge, understanding, and intelligence. Right, return on common equity, you know, here, why we don't have this in IFRS? We don't have to know this. This is good enough. This is good enough. Yeah, that's exactly right. So this is good enough. Why? Why is that? Why is that? In IFRS, how do you treat preference shares? This is important, guys. I mean, don't forget about that. Preference dividend is a debt. So because the preference dividend is a debt in IFRS, does your equity here includes the preference shares? It is already deducted. That's exactly right, Satya. And does this equity includes The equity preference shares, no. So this is good enough. But if you look at in US GAAP, focus attention here. In US GAAP, your net income here it doesn't deduct the preference dividend from it. So similarly, your average equity includes irredeemable preference shares in it. And that's why they have a separate ratio. They want to focus only on common equity holders. I mean, you want to ditch preference shareholders out, chase them out from this ratio. You remove the preference dividend from the net income, and on the common equity, again, you remove the preference shares from the equity, and then that becomes common equity. Hope that is clear. The interesting ratios, I mean, you go through these ratios, don't memorize them, understand them. You will be able to answer any questions on the ratios. Moving further down. Okay, DuPont, the favorite topic, one of the another favorite topics of the examiner. 2 DuPont analysis is available. This is like, why DuPont? You know, one company has a higher ROE compared to other companies' ROE. Do you know why? What could be possible reasons? Can you guys quickly come up with some possible reasons why one company's ROE may be more than another company's ROE? Any reasons? Okay, equity, you know, size of the equity. If you have more equity, then your ROE will be lower because of denominator effect. If you have less equity and more financial leverage, then you will have better ROE. So that is one driver of your return on equity. Anything else that can tell you the difference between ROE differences of different companies? One you said is the debt and equity, which is the debt portion of it. Anything else? Financial leverage is one, and any other things that will decide your ROE differences between companies? What else? Yes, return on assets. So that's your profitability, your net income margin, your net income. Your net profits will have a different higher profit. If you have a higher net income margin, then you will have better return on equity, and vice versa. What more we are talking about? So you are talking about net income margin and then financial leverage. What is the pending item in your ROE drivers? I will put, yes, there you go, asset turnover. Turnover divided by assets, that's asset turnover. So in basic DuPont, you multiply net income margin times asset turnover times what? Times financial leverage, which is total assets divided by equity, is going to give you ROE. And net income margin, you know how to calculate. Net income divided by revenue. Asset turnover, you know how to calculate turnover divided by assets. Financial leverage, you know how to calculate total assets divided by equity. And there is an expanded version. If you want to expand the net income margin more into detail, we're going to put them into 3. What are those? EBIT margin is 1. What are the other 2 things? You have the EBIT margin, and then you have your interest burden times your tax burden times your asset turnover times your financial leverage, and that's going to give you your extended DuPont. It can tell you why extended DuPont. Your basic DuPont doesn't tell you whether your net income is lower because of your core operations or your net income is lower because of your higher interest expense and higher taxes. But if you look at this ROE, you can clearly know when you say profit margins are lower, you know the profit margins are lower. Is it because of your core operations, or is it because of interest expense, or is it because of taxes? And that's why we are talking about the expanded version of return on equity. And that's about that slide. We are going further into ratios, debt to equity ratio, something very, very popular. I want you to focus your attention here. Debt to equity, I'm going to tell you what is super important. Debt to equity and financial leverage, you already know that. And then again, if you see, yeah, there are some ratios talking about operating risk, coefficient of variance of operating income. So you take your EBIT, variance of standard deviation of EBIT. And so basically what we are talking about here is coefficient of variation of operating income. So you're going to identify that as a measure of risk factor for an organization. So that's what you exactly do, is basically you are going to divide the standard deviation, your mean EBIT, by your variance of your EBIT. So that's going to give you coefficient of variation of your operating income, right? So that's, anyway, I don't see much questions coming up on the exam on these topics, but something DuPont and things like this are very popular. Then moving further down to solvency ratios, that highlights you if a company can survive in the long run, is there a risk of bankruptcy? And that's something where we talk about solvency ratios. This is interest coverage, EBIT divided by interest. It will tell you how many times you could pay interest using your operating profits. And then fixed charge coverage, again, not much tested. Interest coverage is more tested. Fixed charge coverage is EBIT plus lease payments divided by interest expense plus lease payments. Will again pass you a similar message, but you are adding to both sides lease payments. That's an easy way to remember. Fixed charge coverage is like you take the interest coverage and add lease payments to the both sides. That becomes fixed charge coverage. Okay, working capital, you know what it is. Working capital turnover, revenue divided by average working capital. Fixed asset turnover, average revenue divided by average fixed assets. Total asset turnover, revenue divided by total assets. As you see, it's like very easy to remember. Turnover is assets divided by revenue, depending on what you are looking at. Working capital turnover, fixed asset turnover, right? And then this is very important, sustainable growth. How do you establish growth rate in a company? I want to spend a minute at least on this, because I know this is not just in FRA, but it has its relationship to other materials like corporate finance and equity valuation. So you've got to understand this in detail, right? So how do you calculate the growth rate of a company? Growth rate should be calculated as, can someone tell me how do you calculate the growth rate? You're going to multiply by, you're going to multiply your earnings retention ratio times what? How do you calculate the growth rate? Retention ratio times your return on equity. That's exactly right. So retention ratio is what? 1 minus dividend payout ratio. So which type of companies would have higher growth ratio, growth numbers? Is it like companies who pay higher dividend payout, or low dividend paying companies is going to have a higher growth rate? Can you think about it? Low dividend paying companies is going to have higher growth rate because they'll be reinvesting more. When you reinvest more, your profits will grow much faster because of your reinvestments. Right? So that's a very important ratio to remember. It affects so many calculations in so many places. All right, so there are like kind of more ratios coming up, cash flow related ratios, and they are not so popular. So I'm not spending much time there. I'm like moving further down. Okay, this is important. Look at this segmental reporting. What is segmental reporting? It is applicable for both IFRS and the US GAAP. So you have, what is commonly tested is how to identify a reportable segment. What is a segmental reporting? You have your common P&L and balance sheet aggregated in your financial statement. When you talk about segmental reporting, what would you want to do? What would you want to do is basically you are going to show segments and split your performance into different segments. If you are, especially it's applicable if you are a diversified organization, you want to split your total performance into different business units and show which unit is giving you more profit. So if you are a geographically diversified organization, you want to split your total P&L and balance sheet into different geographies. Whatever you do, when you want to identify a separate segment, remember you need to make sure that particular segment is generating more than 50% of its revenue from sources external to the firm. External revenue, no intra-company revenues are, let's say, more than 50%, then that won't qualify as a reporting segment. You know, you should sell it outside at least more than 50%. And remember, your revenue or operating segment or assets of your segment should be 10% or more of your total assets or total revenue or total operating profits. Remember, this is revenue or operating profit or assets. It's not all of them. This is something they always twist here, is that do you have to meet all the criteria to become a separate segment, or one of them is more, one of them is good enough? What do you think about it? What do you think about it? Is one of them is good enough, or you want everything else to be met for you to classify as an operating segment? The accounting standard setters obviously want as many as segments as possible so that it gives better information to the user. So they don't really tell you, okay, your division should, your segment should have more than 10% of assets, more than 10% of profits, more than 10% of your assets. No, they just say either this or this or this. Maybe you are contributing 15% to assets, but on revenue and operating profits less than 10%, it doesn't matter. You become still a separate segment because one of these conditions is good enough for you to be a separate segment. Right, so that's an important thing. And credit rating process. If rating agencies are assigning credit rating for your organization, what do you think are the key ratios that they are going to focus? They are mainly going to focus on the key ratios that they are going to focus are solvency ratio and interest coverage. So they're going to focus, some ratios to see if your financial risk is low, or they are going to see if your ability to pay debt. You know, you see your total debt to EBITDA, return on capital, debt to equity, debt to total capital. Not so difficult, isn't it? Right. So I mean, these ratios, you don't have to memorize them. And if they are talking about it, they are going to tell you return on. They're going to tell you free operating cash, free cash flow to the total debt, and then you know what is free cash flow, you know what is debt. So you don't have to memorize these ratios. You just got to know what is operating free cash flow to the firm and total debt. So that makes FRA not so complicated because you don't have to memorize formulas. You just need to know. All right, so I'm going to go into individual segments like inventories, long-lived assets, income statements, and things like that. I'm going to cover up the key points on each of the topics. Okay, this is your inventory valuation. So when you're talking about inventory valuation of assets, what are the key points? In US GAAP, all inventory methods, LIFO, FIFO, average method, and specific cost identification are allowed, but in IFRS, LIFO is prohibited. First thing to remember. And remember, focus your attention. In the next 30 minutes, we are going to wrap up these sections. And this 30 minutes is going to be very intense and very important factors that you need to know for your exam. So it's going to be very important. The first one is LIFO is prohibited in the US, something that you need to know. And then you need to know how to calculate COGS, opening inventories, plus purchases, plus minus closing inventories gives you your COGS, accrual concept, that's all fine. And then now when you look at LIFO and FIFO, you need to understand what, in terms of rising prices, this is a very important slide. This portion, this is super important, that very often get tested. The table gets revised in declining prices. Okay, income statement, if you are using LIFO, rising prices, what happens to COGS? The first thing I tell you to think about, only know one thing, everything else is a derivation from that. think about what happens to closing inventory, ending inventory. That answers everything in a much easier manner. So look at COGS. You have, they're asking what happens to COGS in rising prices in LIFO. Do you want to memorize? And don't memorize. It's easy to remember the implications. Think about this way. You're talking about LIFO, right? So if you're talking about LIFO, the last inventories are out. So whatever with you is what inventories. Do you have old inventories with you or latest inventories with you? Think like that. What inventories do you have in LIFO? Whatever came in last, you sold it. So whatever you have is old inventories. So your old inventories, are they high price or low price when you're talking about an inflation? When you're talking about an inflation, they are of low value. So that becomes your closing inventory. So if your closing inventory is low, because whatever you are left with at the end of the day, end of the year, is with your opening inventories, and that's of low values. If that is low, what happens to COGS? What happens to COGS if your, what happens to your COGS when your closing inventory is low? When your closing inventory is low, what happens to your COGS? Cost of goods sold. It is high because closing inventory gets deducted. So your COGS is high. When the COGS is high, earnings before taxes are lower. Obviously, taxes are lower because low profit. Net income is lower because of lower profit. Inventory is lower because of lower closing inventory. Working capital is lower because inventory is lower. Current assets is lower. Retained earnings is lower because of lower net income. CFO is higher because of lower taxes. Don't forget, CFO is higher because of lower taxes. CFO is higher. So you only have to know what happens to the closing inventory. Everything else works the other way, works in a meaningful manner. Hope you get what I mean. And in terms of falling prices, think about LIFO again. I don't want to explain FIFO. This is the opposite of that. But if you talk about falling prices, deflation. What happens? Prices fall. If you use LIFO, what will happen to your inventories that you have will be old inventories, and they will be expensive now because currently the prices have gone down. So whatever you sold recently is the low cost inventory. Whatever you have is expensive because now deflation, earlier it was not. So your closing inventory is going to be what? Going to be high. When the closing inventory is high, lower COGS. Lower COGS means higher EBT, higher taxes, higher net income, higher inventories, higher working capital, higher retained earnings, and lower CFO because of higher taxes. Hope that is clear. That's a significant slide. And then you have to also understand periodic inventory system and perpetual inventory system. In a periodic inventory system, you update your inventory register only end of the month, but in a perpetual inventory system, you update them on a real-time basis. So FIFO is the same for both, but LIFO and average cost would give you different results in when different net income and different inventories when you are using periodical and perpetual inventory system. But that's not super important. What is important is your FIFO LIFO relationship. For rising prices and falling prices, it's just going to be the same. That's not going to change. So that's important to understand. So moving further down, okay, inventories. How do you value inventories? Inventories are valued at lower of cost or NRV, whichever is lower, both in the US GAAP and in IFRS, both. But now, okay, before I want to tell you something else, but before that, you need to understand what is NRV. You know, cost. Cost is the cost incurred to bring an asset, bring an inventory to its present location and condition. So you exclude abnormal cost, abnormal storage cost, selling cost, admin overhead. It includes the cost of your inventory or the production cost, conversion cost, plus the inbound Transportation costs of bringing your raw material into your production factory or into the warehouse, but you exclude everything else, right? So now that's cost. And what is NRV? The value at which your asset, your inventory can be sold after deducting your sales related costs. So you can sell your inventory. Let's say you got an inventory, you can sell it for $15, one inventory, one unit, but it's not, if it is completed, it's a final product, then you don't have to deduct estimated cost of completion because it's a completed product. So you have your selling cost and that becomes your NRV. But if you're talking about a work in progress, or if you're talking about raw material, then you know the estimated selling price of the final product, but you still have to convert and incur some conversion cost. So focus this. And you might wonder why we are deducting cost of completion, because that is relevant if you are not talking about a finished good. If not, it's not relevant. If you're talking about, let's say, a raw material and the estimated selling price of the final product is like 15, but you still have to manufacture, there's a conversion cost of $5, deduct that. There's a selling cost that you have to pay, like transportation or commission or whatever, $2. 5 plus 2, 7. So your NRV becomes 8. That's how you understand NRV. The cost that you can sell your output, final output to customers after deducting estimated cost of completion and selling costs. Remember that, that's NRV. So whichever is lower, you show your inventories at that. But you know, one thing to remember is that if you are using, it's the same thing in US GAAP and IFRS, but if you are using LIFO or retail method in US GAAP, mainly if you are using LIFO and retail method, you change your view. You don't use cost or NRV. Instead, you use cost or market value. So that is when, if you are using LIFO. So if you are using LIFO and retail method, what you are going to do is you are going to not going to focus on NRV, but you are going to use replacement cost of replacing your materials or the inventories as your market value. But the replacement cost has an upper boundary, which is NRV. It can be as high as your NRV, but you have a lower boundary, NRV minus normal profit margin. So it has to be in between your upper limit and lower limit. Then it can be replacement cost. And most of the times, the replacement cost will be between your lower limit and upper limit. So your replacement cost can be a good estimate for your market value. So remember, usually cost versus fair NRV, whichever is lower, but in LIFO method in the United States, you don't use NRV, you use cost versus fair value, cost versus market value, and the market value is the replacement cost, which got a upper bound and lower bound. So that's something that you need to remember. And if you are if there is an impairment on your inventory, meaning your NRV is below your cost, there is an impairment write-off. Where will you show your impairment write-off? Can someone tell me? Impairment write-off. In which line in your income statement it should go in? Impairment write-off, which line in your income statement your impairment write-off is going to go in? Which line do you think is going to go on? You have an impairment of inventories. You write off your impairment losses. You have impairment losses in your inventories, in your income statement. Where do you take them? In which line in the income statement it is going to go in? Is it going to go in as an infrequent item, or it's going to go into some other line? Impairment losses on inventories. Don't forget this. This kind of some common sense questions can possibly be tested as well. So what do you think about this? If you have an impairment losses on your inventories, where would you put them? Are you there? Are you going to put them into admin costs? Are you going to put them into selling costs? Or are you going to put them into cost of goods sold, COGS? Where would you put the impairment losses on inventories? Remember, that goes into your COGS. Reversal of impairment losses are permitted in the US GAAP. Next year, if the NRV goes up, then you can reverse to the extent of previous impairment losses, not beyond that. But in US GAAP, reversal of impairment losses not permitted. Pay attention now. Reversal of impairment losses in the US GAAP is not permitted in most of the times, except one area in long-lived assets. I will tell you in a while. Otherwise, reversal of impairment of assets is not permitted in the US GAAP, but it's always permitted in IFRS. But they tell you reverse it to the extent of previous losses. Moving further down. Okay, now this is again something very important. I think that's going to be the last slide I'm going to talk about on inventories. And this is an interesting slide. LIFO liquidation. What is a LIFO liquidation? Focus your attention here. This is a very important topic. LIFO liquidation is a strategy where it is a situation where a firm using LIFO, right, not replacing their sales. I mean, when you do sales, your inventories drop, you have to produce more or you have to buy more to replace your inventories, but you don't do that. So what happens if a LIFO firm does it? If a LIFO firm not using, replacing enough production with, as you're not keeping up your production or purchases to the extent of sales, the speed of sales. So what happens is that your closing inventories, what's going to happen to your closing inventory? So what you look at, inventory units go down and COGS reduced by older lower cost, because now you are going to start using the older inventory, because in LIFO you use latest inventories which may be expensive in rising prices. So you go back and start using older inventories which are of lower cost. So lower COGS means higher net income. But remember, can you sustain this into the future? No. Soon you will be out of inventories, you will run out of business. You'll have to close down your business, isn't it? So remember, LIFO liquidation is artificially high short-term profits generated by companies, LIFO companies, either intentionally or unintentionally not replacing their sales enough. That's what it is. So in LIFO liquidation, your inventories drop or inventories build up. One common sense question for you. In LIFO inventory, in LIFO liquidation, what happens to your inventory? Inventories drop. You need to remember that. Right, so and then you need to also remember LIFO reserve. Which companies need to disclose LIFO reserves? In the United States, only the companies need to report LIFO reserves. The companies who use LIFO method, because they need to tell you what is the LIFO reserve, so that you can add that to your LIFO inventory to convert that into a FIFO inventory, which can be compared with other companies who are using FIFO. This is an analyst adjustment to make things comparable. So look at this. This table, I place a higher emphasis. Take LIFO inventory, add the LIFO reserve, you get FIFO inventory. And if you have LIFO COGS, if you want to make it a FIFO COGS, you deduct the change in LIFO reserve. Your LIFO, when it comes to P&L element, take the change in the reserves. When you're talking about balance sheet, add the reserve itself. But talk about the P&L, you add the change. You see LIFO retained earnings, LIFO reserve times 1 minus tax rate, obviously, because you're talking about profits. Your profits are more, taxes are going to be more. LIFO cash, LIFO reserves, LIFO cash minus LIFO reserve times tax rate, that's going to give you FIFO cash. So remember that, what we are trying to calculate. You have LIFO cash minus LIFO reserve times tax will give you FIFO cash. This is an important table. LIFO liquidation is very important. Don't forget that. Okay, long-lived assets. Right, look at this. Long-lived assets, intangible assets and Property, plant and equipment which gets capitalized in your balance sheet is what we mean by long-lived assets, which are property, plant and equipment. This is an important slide, you know, in the latest mock exam that I had, that I saw your answers individually and I realized there's some problem here on capitalizing versus expensing, how to understand things. Okay, now you need to understand income variability, volatility of income. Where do you think it's more, in capitalizing or expensing? Can we talk about it? In capitalizing or expensing, where do you think you're going to have more income volatility or variability? When you're expensing it, you know, in this year you have you have a capex, you're expensing the capex, a big expense hitting your P&L, and next year there's nothing, and then another capex coming in 2 years down the line, everything goes through your P&L. Your P&L will be very volatile if you're expensing everything, isn't it? Depending on your capex cycle, you know, capex cycle is like companies, they spend money this year, meaning after 3 years they again spend on capex. You know, that's what you do. You don't just invest capex randomly, but when you do that, your P&L will have a big volatility, variability. But if you're capitalizing, you will capitalize everything and it comes as a depreciation over the years. Your earnings get smooth, isn't it? So remember that income variability is higher in if you are expensing and lower in if you are capitalizing. Profitability will be higher. Early years it will be higher if you are capitalizing, because your net income is going to be more. Although your assets are going to be more, the effect on the numerator is more than the effect on the denominator. Guys, you got to pay attention. There's always some twist in the CFA exam about the size of numerator and the size of denominator. Now, if you think about early years, there is an offsetting effect. Yes or no? What happens if you're capitalizing profitability? Not on that, but if you look at return on assets, which is not there. If you look at the return on assets, for example, you know, it's not here, but think about return on assets. You have your return, which is profit, which is going to be lower, higher, because you have not expensed it, but your assets are more. So your assets are more and profits are also more. So if you're expensing, if you're capitalizing, your profits are more in the first year, early years, and assets are more. There's an offsetting effect. But when there is an offsetting effect, what do you think should happen? Which side of the equation in a return of assets is more sensitive to changes? Think about your return on assets is basically your profits divided by assets, or profits divided by equity, whatever it is. Yeah. Which side of the equation is more sensitive, if I ask you? Which side of the equation is more sensitive? You are the denominator or the numerator? Which one is more sensitive? I mean, you're going to adjust numerator and denominator by the same amount. Let's say you have 20 is your profit, assets are 100. So 20% is your 20% is your return on assets. You're going to deduct 10 from both sides. Deducting 10 from numerator will have a more impact. You're right, Basil. It's more impact than deducting from the assets. In here, both going to go up. Let's say I'm adding 10 both sides. 30 becomes divided by 110. Look at the ratio. What happens? 30 divided by 110. What happens? 27%. This is important. If you're adding both sides of the equation by the same amount, where do you normally have the smaller number? That will be more sensitive. And that's why here, if you see, when I ask return on assets on capitalizing, what happens to your return? Your profits will be more in capitalizing, but your assets are also more. So there's an offsetting effect. But overall, we are saying the return on assets is going to be more. Why I'm saying the return on assets is going to be more in the first year? Because of the numerator effect. Offsetting effect is more on the numerator than the denominator. Right. Later years, your profitability drops. Why? Can someone answer why the profitability drops in the later year? Why the profitability drops in the later year when you're talking about capitalizing? Why do you think the profitability drops in the later year? Why is the profitability? I'm not talking about return on assets. A simple question. You are capitalizing, exactly, depreciation hitting you hard. So initially you'll have a higher profitability, later lower. Total cash flow is the same. But where will you put your cash is different, isn't it? I mean, in cash flow from operating, if you're capitalizing, will you put your capex, your spending, as a CFO or CFI? Where will you put? If you are capitalizing, where are you going to put your capex? Are you going to put them in operating activities, or are you going to put them into CFI? Where are you going to put them? Yes. Okay, you're going to put them under cash flow from investment activities. Put them under investment activities. We are capitalizing, but if you're expensing, you're going to put it in operating activities. Now, this is always people come and ask me. I mean, you say you're going to, if you are capitalizing, you're going to put them in investment activities. So the investment activities should be higher because you're putting it there. What's the logic for that? Can someone explain me? Maybe I can confuse you to check if you're getting this trick. I'm telling you, capitalizing means you're going to put your capex in your CFI. You're going to put your capex in your CFI. There you go. That's the point, Safi. You got the point. That's specifically what you need to look at. It's an outflow in CFI, so it would reduce the CFI. Pay attention to these minor things which can help you to do the exam. So CFI is going to be lower because you're going to put it as an outflow. If you put it as an outflow, your net cash flow is going to go down. So that's why CFO is more if you're capitalizing, and lower. Debt to equity ratio will be lower because of the higher equity. Debt is unchanged, but equity is lower. Hope that makes sense to you. Moving further down to the next slide. And these are the depreciation methods. One thing that I can tell you, in the double declining method depreciation, when you are calculating depreciation, cost minus accumulated depreciation divided by the total useful life, not remaining useful life. A lot of people go wrong there. Total useful life times 2, always times 2. So now, what is different in double declining compared to straight line or any other methods is that you don't deduct the salvage value or residual value, but you do deduct that in the declining depreciation. And don't forget that. And now, the one more thing that you need to understand, if you're increasing the useful life of assets or increasing the salvage value, doing both, what would happen to your future depreciation? What are you trying to do? Increasing the useful life, increasing the salvage value. What's your objective of doing? What are you trying to achieve by increasing your useful life and salvage value? Are you trying to decrease the depreciation, or what? What are you trying to do? Increasing the useful life of your fixed assets and increasing the salvage value. What would happen to your depreciation? Your depreciation will decline. So you're thinking to increase your net income by decreasing these two. But if you are decreasing the life, decreasing the salvage value, future depreciation is actually going to be more. Okay, now I have a different question. If you are increasing the salvage value, what would happen to your double declining method of depreciation in the early years? Nothing would happen to your double declining method of depreciation because you are not going to deduct salvage value. Okay, component depreciation, what do you think about it? If you have a large asset with different components to it, in IFRS, you've got to depreciate them separately, but in US GAAP, is the component depreciation prohibited? Yes or no? Is the component depreciation prohibited in the US GAAP? Yes or no? Would you agree with me? Is the component depreciation prohibited in the US GAAP? Would you agree or disagree? No, it's not prohibited. So if it is no, then what do you think it is, Sakti, then? If it is not prohibited in the US GAAP, component depreciation, so then what? It is up to the firm. It's the choice. It's a choice in IFRS. It's mandatory. Very important slide again. Right. So long-lived assets, you know, again, intangible assets, that's coming in, something that you got to remember. One thing that I can tell you, research expenses, expense in US GAAP and IFRS. Development expenditure in IFRS, capitalized, subject to meeting conditions. The conditions are given here. Most of the conditions talk about whether you will be able to successfully come up with a final product or not. If you can, then you capitalize. If not, you even expense the development expenditure. But in the US GAAP, both research and development expenditure, both of them, you expense them. And then what about internally generated software development cost? If a software is developed for sale, you capitalize only when the feasibility is established. But if your software is developed for internal use in IFRS, you do the same thing. You go by the technical feasibility. But in the US GAAP, internally generated software costs are always capitalized. Don't forget this again. And then I think that's probably the most of the differences you need to look at. And what about intangible assets which got infinite useful life? What is something which is coming to your mind when I talk about intangible assets with infinite useful life? Is anything coming to your mind? Goodwill. Something else coming to your mind when I say intangible assets? Renewable licenses are again infinite. Renewable licenses, what are specific about them? If I ask you from a technical perspective, what is so specific about them? What do you think is so specific about them? Not depreciated or amortized. Very good point. There's one more thing that you need to talk about. They are not amortized. Check for impairment on an annual basis. On an annual basis. For other assets, you check for impairment when there is an impairment indicator is present. But for these assets, you test for impairment annually because they are not impaired, they are not amortized, so they have a greater chance of asset impairment. So remember that. So that's pretty much sums up this particular slide. Moving further down to upward revaluation of assets. Can you follow revaluation approach in the US GAAP? Yes or no? Can you perform US upward revaluation? No. But in IFRS, it is an option, not a mandatory. Where do you take the gain in IFRS revaluation reserves? You take the gains to OCI, losses to income statement if the losses exceed the revaluation reserves in your balance sheet. And reversal of impairment losses in IFRS is permitted, and in the US GAAP is not permitted. So that's again something that you got to remember in terms of revaluation, how to look at things, and let me know if you have any doubts on that. And remember something that I said, always I said, this is a very important slide. I think that's the last slide on long-lived assets. Right, so in long-lived assets, the impairment testing is a very important topic, and that's different in US GAAP and IFRS. In IFRS, how do you carry out an impairment testing? We are going to compare two things. What are the two things are we going to compare? Can come up with those two words? What are the two things that we are going to discuss in IFRS? What are the two things that you're going to talk about in IFRS when you are comparing, doing an impairment testing? Value in use, yes. Value in use, what is the other one? Fair value, less cost to sell, isn't it? And higher of these is, how do you call them? higher of these two, value in use or fair value, you're going to take fair value less cost to sell. Make sure that you always say cost to sell, because in US GAAP, there's no cost to sell in impairment. But in IFRS, there is. So you're going to compare the value in use and fair value less cost to sell. You're going to compare those two and get the higher number. And the higher number, how do you call them? Can someone tell me the technical term for that? How do you call the higher number? The value in use and the fair value. What is the name for that? There is a specific name for that. How do you call it? Is that called carrying value? Is that called carrying value? Yes or no? Is that the carrying value, higher of value in use and the fair value? Yes or no? It's not, isn't it? It is a recoverable amount. This is what you're going to check with your carrying value and see if the recoverable amount is less than the carrying value, then your asset is impaired. If the recoverable amount is more than the carrying value, your asset is not impaired. So you're going to pay attention to the terminology here. And then what you do, you compare the carrying value and your carrying value and your recoverable amount, impair the asset if it's needed. But in the US GAAP, impairment testing is done in two stages. One is recoverability test. You're going to compare the carrying value with something. What are you going to check at the recoverability test? What are you going to check your carrying value with to decide whether the impairment has occurred or not? You're going to test the carrying value with the undiscounted future cash flows of the company, of the asset. Don't get confused this with value in use. Value in use is the same, but it is discounted. Future cash flow that can be generated by using the asset, discounted at the company's cost of capital, is what value in use. But in the US GAAP, you look at undiscounted cash flows, which is not value in use. If the undiscounted cash flows are more than the carrying value, you don't go to the second step, you stop the impairment testing. But if the undiscounted cash flows are lower than the carrying value, then you calculate the impairment loss as the difference between carrying value and the fair value. You don't look at undiscounted cash flows anymore. You just, okay, undiscounted cash flows only tells me that there is an impairment. Then I go into the next step. I'm going to compare the carrying value and the market value, fair value, but I will not deduct cost to sell. Focus on these tiny, weeny points. They are very important in the exam. When you're carrying out this fair value, less cost to sell is not there in US GAAP. So it's fair value and the carrying value is the impairment. What if the fair value is not available in the US GAAP? If you answer this question, you're probably in the top notch in FRA. If you do not have the fair value of the asset available in the US GAAP, how do you calculate the impairment? Basically, recoverability test is met, meaning that, your undiscounted cash flows are less than the carrying value, there is an impairment. Now, you have to calculate the impairment loss as a difference between carrying value and the fair value. But the fair value is not there. What would you do now? How are you going to calculate the impairment loss then? You know there is an impairment because your undiscounted cash flows are lower than the carrying value, so there is an impairment. So how do you calculate the impairment if you don't have the fair value for the assets? Any answers? Anyone want to talk about it? How do you calculate that if the fair value is not available when you are calculating impairment testing in the US GAAP? Probably this is something that you have not really paid attention to it. You go by the value in use. So not that value in use as a concept is not used in IFRS, in US GAAP. It is used when fair value is not available. Hope that is clear. If you have a question, please raise it up to me. And then we are moving on to the next topic, is basically income taxes. So we're going to have income taxes. So in the income taxes, something very important points I'm going to tell you. pay attention to this income taxes topic. And what is income taxes? This is what in your income statement, if you start to think about, erase your memories on long-lived assets impairment, we move on to income taxes now, coming to income taxes. So if you look at income statement, you have your pre-tax profits, and then you have your taxes, and then you have your after taxes, you have your pre-tax income, and then you have your taxes, and then that gives you basically that gives you your after tax net income. Right, this taxes comprises of 3 elements. So what are those 3 elements in income taxes? The 3 elements that comes into your income taxes are: number 1, current taxes, changes in deferred tax assets, and changes in deferred tax liability. So that's what is the meaning of these income taxes. In the income statement, what is your effective tax rate? Your effective tax rate is your income tax for the period which reported in the income statement divided by your profit before tax, pre-tax income. So look at this, income taxes including all the deferred taxes etc. in the P&L divided by pre-tax income is going to give you your effective tax rate. Okay, now what is the deferred tax assets and deferred tax liabilities? Why do they come in? Why do they come in? Can someone answer this question? Why do you think the deferred tax assets and the deferred tax liabilities coming in? Why do you think the deferred tax assets and the deferred tax liabilities coming in? Because of what? Why in accounting, we're talking about of the differences in accounting treatments relating to permanent differences or temporary differences? What do you think we're talking about? Is it because of the temporary differences or temporary differences? You call it timing differences, and that's why you have a difference coming called kind of deferred tax assets or liabilities. Like for example, in accounting, maybe you are using a useful life of 10 years, but in the tax, they are allowing you to deduct the expenses much earlier, like 5 years or so. That's where you have these differences of treatments, timing differences over a period of 10 years. The depreciation is going to be the same in tax books and the accounting books, but temporarily there will be a difference. So what is deferred tax liability? Meaning your taxes are currently low, but in the future taxes are going to be more. This is when you are charging more, we are claiming more expenses now, and you're paying less taxes, but in the future you're going to pay more. But when you talk about deferred tax assets, what does that mean? You're paying more taxes now because maybe the government says you delayed capex relief, so you're using 10 years in the tax depreciation but 5 years in the accounting depreciation, so you claim your capex later. So you currently paying more taxes because your taxable profit is more, but in the future your taxes are going to come down. So remember always that deferred tax liability means in the future your taxes are going to go down. Deferred tax assets means you currently pay more taxes, in the future it is going to come down. So that's understand these different things in the income taxes. And moving further down to changes in the tax rate. I mean, these are very often, these questions will come up in the finances, in the CFA exams. If the interest rate is increasing, what would happen to your, if you have a deferred tax liability, you have a net deferred tax liability, your income tax rate is going up, then are you going to have an income tax expense or reduced income tax expense? Think logically. Your tax rate is going up. You have a net deferred tax liability. You have a deferred tax assets, you have a deferred tax liability, but on a net basis, you have a deferred tax liability. So if you have a deferred tax liability on a net basis, what do you think what's going to happen to your income taxes when the tax rates go up? When the tax rates go up, what happens to your deferred tax liability? Will it increase or decrease? Will it increase or decrease? The liability goes up, because how do you calculate the deferred tax liability? It's the difference between accounting base and tax base multiplied by the tax rate. Remember that the deferred tax is always tax base minus the carrying value of accounting base times the tax rate gives you deferred tax assets and liabilities. That's what your deferred taxes. So if the tax rate is increasing, whatever it is, you have deferred tax assets that will go up, deferred tax liabilities will go up. But if your net position is a liability, it will increase your income tax expenses. But if your net position is a deferred tax asset, increase in the tax rate would reduce your income tax expenses. Remember that again. If you have more assets, deferred tax assets, than the liabilities, when the tax rates go up, your increase on your assets will be more than the increase in the liabilities. And when the assets increase, is an income, so which means income taxes drop. Understand these minor things. It's just mathematics. Mathematically think what happens. That's what it's going to be important. And changes in the tax rate, is it a policy change or estimation technique change? Changes in the tax rate, is it a policy change or estimation technique change? What do you think? Tax rates are changing, increasing from one to another. Is it a policy change or estimation technique change? Estimation technique change. Is it a prospective application or retrospective application? What is needed? What do you use? Changes in estimation techniques. Prospective application. Estimation techniques is always prospective application. That's what you use. So remember that. Estimation techniques prospective. Changes in policies retrospective. Correcting prior period errors retrospective. Okay, the last thing I want to talk about in deferred taxes in our session today is that we're going to talk about valuation allowances. Now, you got a deferred tax assets. A great example of a deferred tax asset is a tax loss. You have a carried forward tax losses that you have in your balance sheet as a carried forward tax losses, which is a deferred tax assets. Why? Because this is a loss that you have, meaning the tax department needs to pay you money, but they won't pay you. They tell you, keep this set off against future profits. That's what you do. I mean, think about it. If you have a profit, you pay taxes to the government. But if you have a loss, will the government pay you? No, they will tell you, keep it in your balance sheet. When you make profits in the future, you reverse them. You don't pay taxes till you set it off with that. That's what they tell you. They are very smart. They don't pay you the money. They tell you keep that loss because they know you're never going to be profitable. So you will never be able to claim the tax losses that you have in your balance sheet. So that's where the problem comes. If you have a deferred tax assets, is it recoverable? Can your deferred tax assets become cash? Will it reduce your future taxes or not? If you believe you're not going to make enough profits in the future, obviously there is no way that you can claim it, and probably your deferred tax assets will go lapsed, unexercised if there is a maturity period for that. Then what you need to do is, you have, let's say, a deferred tax asset is 100 in your balance sheet, and you feel 30% of this is not going to be recovered. So if it is an asset, you need to receive money. If it's a liability, you should pay money. We are talking about assets. Assets means you receive money. So when you are receiving money, you go to receive money, but from an asset. But if you think you are not going to make enough profits in the future, how will you use your tax losses to claim the release? You can't, isn't it? And that's where you say your deferred tax assets is 30% lower than 100. So 100 minus 30 becomes 70. What is the name for this 70? Can someone tell me what is the name for this 70? Sorry, 30. 30. The 30 is the valuation allowance. So valuation allowances, will it decrease your deferred tax assets or increase your deferred tax assets? Can you tell me? Valuation allowances, will it decrease your deferred tax assets or decrease your deferred tax assets? What happens? If you are using higher valuation allowance, increasing the valuation allowance means that you are not going to receive part of it. So you're creating a provision. Think about allowances here as a provision. So that's going to decrease your deferred tax assets. So if the deferred tax asset decreases, what will happen to income tax expense in the P&L? Your income tax expenses, will it go up or come down? If the assets coming down, remember assets coming down, what will happen to your expense in the P&L? Asset is coming down. If the asset is coming down, expense goes up, the income taxes go up, net income comes down. Look at depreciation as an example. Depreciation means when asset comes down in value, that reduces your profits. Same applicable everywhere. When you have asset is decreasing, means the net income should come down. If the net income to come down, your taxes should go up. What if a company is trying to decrease its valuation allowance? What are they trying to do? Can someone tell me? What are they trying to do? If they are trying to reduce, what are they trying to do? If they are trying to decrease the valuation allowance, are they decreasing valuation allowance? Means what are they trying to do? They are trying to, okay, now reduce the valuation allowance. Now, Sati, you got to think about it. If you're reducing the valuation allowance, what will happen to your deferred tax assets? Your deferred tax assets would go up or come down. Your deferred tax assets, you are, what are we doing? What did I say? You are reducing your deferred tax assets, isn't it? Your deferred tax, your valuation allowance is being reduced, meaning your provisions are reduced. So what happens to your deferred tax assets? That's exactly right, Basil. When you are reducing the valuation allowance, it's a provision. It's like a provision for bad debts. Here, you are calculating this provision to the extent that you will not receive your deferred tax assets. So that's a provision. So that's going to reduce, means your deferred tax assets go up. So if the asset goes up, what happens to net income? What happens to net income? Asset is increasing, net income increasing because you want to reduce taxes. You're increasing deferred tax assets because you want to reduce taxes. You want to boost your profits. Is that clear? Think about it. If valuation allowance is reduced, company wants to increase profits. If the valuation allowance is increased, company wants to decrease profits. So valuation allowances are often used to manage profit in the manipulation of your profit. This is extremely important. Make sure you are able to explain to yourself this particular point. What is valuation allowance? It will reduce your assets. So if you increase that, your assets will come down more, your income tax will go up, net income comes down. But if you're decreasing valuation allowances, your deferred tax assets are going to go up. When the asset is going up, tax is going to come down, net income is going to go up. It's a very simple logic. Asset going up is an income or reduction in expense. Assets coming down is a write-off. It's a writing off. It will increase expense, isn't it? And decrease the net income. A simple logic. Hope you understand that. Focus on that. The deferred taxes, the valuation allowances, that's something important you need to understand. Right, so that's about it. Okay, that's about it. And I want to tell you something more. Give me 2-3 minutes and then we are going to be done. Now, I want to tell you something. Remember, I always said reversal of losses, impairment losses on inventories, fixed assets, in which regime it's permitted and which regime it's not permitted. In which regime it's permitted and which regime it's not permitted, the reversal of impairment losses, in reversal of impairment losses, in which regime is permitted and which regime is not permitted. Reversal of impairment losses is a gain, isn't it? It's like a revaluation gain. It's in IFRS, it's permitted because they permit revaluation, so they should permit reversal of impairment losses. But in US GAAP, it is not permitted. Reversal of impairment losses in US GAAP is not permitted. But remember something, for asset held for sale, if you talk about asset held for sale, I can even show you where exactly that is there. Asset held for sale, I'm looking at asset held for sale. It is definitely in here. Okay, look at this. Asset held for sale. If you have an impairment loss on the asset held for sale, if you're classifying an asset as a held for sale at the time of classification, you compare the fair value less cost to sell and book value and see if the asset value is lower, you write it off, but you don't look at value in use because you're not going to use the asset. If you're going to reverse this impairment loss on an asset held for sale, this reversal is permitted in both IFRS and US GAAP. And remember, this is the only reversal of impairment losses which is permitted in the US GAAP. Everything else is prohibited. So if you have an asset held for sale, which is discontinued operations, hope you remember, you classify an asset as a held for sale. It's not held for trading. You know, you don't think about financial assets. I'm talking about long-lived assets. If you have a asset classified as a business unit or a subsidiary, you're going to sell them, and if you charge impairment losses now, next year you think it's gone up in value, can you reverse the losses? It's permitted in both US GAAP and IFRS. Having said that, that's the end of taxes, and then, you know, I'm going to leave long-term assets, long-term liabilities for you to go through. There are a few slides on long-term assets, and I'm just going to spend a couple of minutes on the last topic on FRA, which is like the differences between financial reporting quality and earnings quality. And remember, this is one separate reading. So if it is a one separate reading, it will definitely get tested. The separate LOSs for that, it's a high chance that they get tested because you're going to have 36 questions, around 30 odd questions in FRA. So around 32 questions, definitely, you know, it can be one question on one of these. Okay, coming back to the point now, what is financial reporting quality? Financial reporting quality is basically, are you reporting your results in a true and fair manner? Are you reporting your profits as they are? As you are reporting your assets and liabilities in the balance sheet as they are, to reflect the economic reality in your balance sheet. Are you doing that? Or are you trying to manipulate, massage earnings, increase earnings when the earnings are lower, decrease earnings when earnings are higher? Are you trying to do this? If you're trying to do that, financial reporting quality is lower. Okay, now, what is the meaning of aggressive accounting treatment? If I tell you something, what is an aggressive accounting treatment? Can you tell me if a company is using aggressive accounting treatment, what are they trying to do? Are they trying to overstate the earnings or understate the earnings? What are they trying to do? If they are trying to be aggressive, if they are trying to be aggressive, they are trying to overstate the earnings. Okay, now I'm going to ask you a question. What is conservative? Conservative means you are trying to reduce the profits during a period. Right? Earnings smoothing means when profits are lower, you increase the profit. When the profits are higher, you decrease the earnings. You never tell the shareholders what is the true profits. So they don't know, you keep them in dark. You don't tell them what the true profit. The financial statement do not reflect the economic reality of the business. Either you want to tell them things are good when the things are bad. You want to tell them things are bad when things are good. You know, you want to always manipulate because you want to manage people's expectations. That's where the whole ethics coming into the picture here, because people always try to manage things, manage people's expectations. You think that you can live that way in life, and which is obviously, you know, it's not the right way of living, and that's why we have all these ethics and things coming up. So coming down to this, both aggressive accounting, conservative accounting are bad. Okay, now I have an interesting question for you. A company is reducing its valuation allowance unnecessarily. Are they trying to be aggressive or are they trying to be conservative? A company is reducing its valuation allowances. Are they following aggressive bias or conservative bias? They are decreasing their valuation allowance on the taxes, on the deferred tax assets. Are they following? They are following aggressive. That's exactly right, Basil. An interesting, intelligent guess, intelligent answer. You decrease, because you decrease the valuation allowance means, what are you trying to do, Basil? Can you explain one more time? You seem to be on top of this material. So can you explain us what happens when you have deferred tax assets? You know, when valuation allowances go down, what happens to the deferred tax assets? When the valuation allowances go down, what happens to your deferred tax assets? It increases the DTA. If the DTA increases, can you tell me what happens to your income taxes? What happens to your income taxes when the DTA increases? When the DTA income taxes, there is something missing in your increase or decrease. It goes down. Yeah, it goes down. It reduces taxes. And what happens to your net income? What happened to your net income? Your net income increase. So that's why it's aggressive. So your answer is perfect, as well as the explanation. Now I'm going to ask you two more questions and then we are done. Next question. A company is trying to decrease the useful life of assets. Decrease the useful life of assets. What are they trying to follow? Aggressive accounting or conservative accounting? A company is trying to reduce the useful life of assets. Yes, that's exactly right, Sati. Why? Can you explain us why that happens? If you have decreasing the useful life of the assets, what happens to your depreciation? Your depreciation increase, net income comes down, so that's conservative accounting. This is the only thing that you got to remember. Even deferred tax assets is the same logic. Valuation allowance is changing. What's happening? Whether it's increasing or decreasing your profits. The last question. If tax rate is increasing, because of that, deferred tax liability is increasing. Tax rate is increasing, because of that, deferred tax liability is increasing. Is it aggressive or conservative accounting policy? Tax rate is increasing. Is it aggressive or conservative accounting policy? And you have a deferred tax liability on a net basis. Okay, I don't want to dispute. Technically, you are right, because the liability goes up, the income taxes increases, your profits come down, it's conservative, you are right. But remember, conservative or aggressive is management deliberately manages earnings, isn't it? When the tax rates go up and come down, if your P&L is going up and coming down, would you call them aggressive or conservative? If I have given you one more choice, then I wouldn't have accepted your answer. If I had given you, okay, it's neither of them. It is neither of them, isn't it? It's just that the company is following the increase in tax rates and it's being accounted. It's neither conservative nor aggressive. You're accounting for the changes in the tax rates. Tax is managed, exactly, you are right. Tax is not up to the company. So that's what it is. If you are changing your estimates, and that is when we are talking about financial reporting quality issues. That's a very, very important point here. And then, I mean, you see a lot of signs of reporting quality issues. What you're trying to do, free on board at origin or destination. You are changing the shipping terms so that you can recognize revenue faster. Accelerating orders before the year end so that you do kind of more revenue before the year is over. So bill and hold, you bill but don't deliver and recognize the revenue in the P&L. So all these things that the companies do is to accelerate earnings recognition, which is aggressive form of accounting. And remember, that's not right. Now I have another question. Changes in revenue recognition policies. Do you need restatement or prospective application? One more thing. Changes in the revenue recognition retro, because it is, why it is retro? Because it is changing accounting policy, not estimation technique. And these are the estimation techniques. You can change the warranty, change the valuation of deferred tax assets. Look at what all of them, what they're talking about is whatever we discussed. You change depreciation, you change valuation allowance, you change warranty provisions, doubtful loan provision. Why? If you are changing these, because these are management estimates, you are changing this. This is a potential red flag for an analyst to look at this and see, okay, maybe there is a conservative or aggressive form of management or earnings smoothing is out there. You got to focus on this. And then the last thing is you need to understand what is earnings quality. You talk about financial reporting quality, and you also need to understand, that's the end of your topic. Is about 52 slides. I mean, I think I skipped about 5-6 slides on the long-term liabilities. Please pay attention to that. Always reach out to me, you know, if you have any questions on them. We can always talk about it before your exam. But for the moment, remember, financial earnings quality is basically how much of your revenue is coming from your core business. If you have more revenue coming from your non-core business, you are selling your peripheral assets to bring revenue, or you are reversing impairment losses and recognizing revenue. Non-core income is more than your core income or accounts for a significant portion of your net income. That is a higher earnings quality or lower earnings quality. What do you think? If you have more income coming from non-core sources, is it something that you should be happy about or something you should be concerning about? You should be concerned about it, because some of your significant portion of your revenue is coming from non-core sources, which may not be sustainable. So sustainability of earnings is the point in earnings quality. But in financial reporting quality, you look at whether your reported profit is reflecting the economic reality or not. Remember that they are different things, and hope you are able to understand the differences. So that's the end of a heavy topic in just 2 hours and 45 minutes. We just try to wrap up the whole FRA, highlighting you the key points, and hope that's kind of a refresher for you, or some of the things you have forgotten, you kind of able to recall. So I'm going to just give you like a 7, let's say you must be very tired. So let's take a 10 minutes break, and can we spend about 30 minutes on looking at some questions to see how your tired brain is responding to some of the questions. Yeah, can we do that? If all of you agree, can we just take a break for 10 minutes and then look at some questions, and we finish up by 6:30. Yeah, agree? Okay, super. There's going to be some questions in the review questions. So we're going to like what we did in ethics, Mohammed, in the morning, we're going to look at some questions here on FRA from the review workshop. It's not an exam, obviously. It's just going to be a review question, some questions we're going to discuss to understand the approach, like how we did in ethics. We're going to look at some questions that we are going to do like what we did ethics. So I'm going to see you in 10 minutes. We'll go up to 6:30 max and see how we go about it. All right, guys. Thank you. See you shortly. So let me repeat myself. So when you are attempting questions on ethics questions, you probably feel your ethics questions tends to be more bulkier. But in FRA and other topics, probably the questions tends to be shorter than a lot bulkier. So you tend to feel that in the exam. That's something that I have always felt when I especially do complex questions. The difficulty level on your actual CFA exam is not really going to be really high compared to the analyst prep questions that I gave you. The mocks that we have been doing over the last couple of months, they are like kind of more time consuming. Not that they are difficult, they are not difficult as such, but they are more time consuming. But this is what we are currently seeing today. What I've been seeing is possibly the type of questions that you see. And so again, why I'm telling you is this: you attempt all these questions in the review workbook completely, and that certainly helps you if you kind of do this. And if you know, I mean, it's not that you do this, I mean, check your answers, okay, fine, I'm like kind of 65, 68, it's good. Whatever you go wrong, wherever you have gone wrong, understand why you go wrong, what is happening there. Then that can definitely improve your chance of passing your exam a couple of weeks from now. All right, so let's get into this question pack now. Okay, there you go. I'm going to tell you the question numbers and take the page specifically to there, and then you guys are going to tell me the answer quickly, and I'm going to also run a timer here. Okay, let's start. Are you seeing the slides? Are you guys all there? Are you seeing the slides? Let's see. I mean, how many of you are still active and sending me answers to all the questions? And come on, guys, you just got 2 more weeks, a little more for your exam. So it's a time that you need to, I mean, if you manage to answer most of the questions today, that tells you you're kind of in good form, right? Okay, look at 104, slide 104. It's a good question. Look at 104. Let's read it together. If the inventory values have been written down due to the fair market value, reversing the write down if the market value subsequently recovers is permitted under IFRS but not US GAAP, US GAAP but not IFRS, both IFRS and US GAAP. What is your answer? Anyone else? I received answers so far from 4 people. What about the rest? What do you think about it? If the inventory values have been written down due to fair market value, reversing the write down if the market value subsequently recovers is permitted under. Okay, that's a good one. IFRS but not the US GAAP. That's exactly the correct answer is A, because the reversal of impairment losses in IFRS is not permitted. Okay, now you need to tell me something. Reversal of losses of assets are usually not permitted in US GAAP, but there is only one type of assets where the reversal of impairment losses is permitted. I just told you before we ended the FRA revision. What is that? asset held for sale, isn't it, Sati? It's not available for sale. Asset held for sale. AFS is your investment securities, isn't it? Investment securities, that's anyway accounted for at fair value, gain or losses. That's financial assets. When you're talking about fixed assets, assets held for sale, which means you got assets which you probably want to sell them. Yeah, I hope that clarifies, because the whole discussion on this impairment or whatever is limited to fixed assets. It's not, we are not talking about AFS or held to maturity, you know, that's like, we know that's different. We have covered that separately. All right, so that's right. The answer is A, and then that's fine. Okay, the next question, 105. Writing down year-end inventory would most likely improve which of the following group of ratios for the period? Will improve. Writing down the year-end inventory values would most likely improve which of the following group of ratios for the period? Inventory write down. Which ratios would improve? So if I got only 3 answers, I would like to receive more answers for this. Out of the 3 answers, I got only 1 answer which is right. Only 1 person has answered the question correctly. So I would still want answers from others. Writing down the year-end inventory would most likely improve which of the ratios? Group of ratios. Okay, 2 correct answers. Anybody else wants to answer? You're writing off inventory. Think about it. This is where I can greatly help you in improving how to think here. This is where, I mean, if you're getting this question wrong, then probably there is like some connectivity issue. You know the ratios and you know what their ratios are, but when you are connecting things, you are a bit lost, so you're not able to. So I would recommend you write down the ratios quickly and think on those aspects. What do you think happens? If you are writing down the inventory value, what happens to your net income? First of all, can someone answer this question? What happens to net income if you are writing off is impairment? You are writing down inventory values. Your inventory values are going down. It's an impairment loss. If you have an impairment loss, what happens to your profitability? What happens to your net income? It goes lower. That's exactly right. It goes lower. Okay. Number 2, liquidity ratios. What happens to liquidity ratios? What are the liquidity ratios? Can somebody give me an example? We removed profitability ratio from the calculation. Liquidity ratio. Can you give me some example of liquidity ratios? Current ratio, great. Basil, current ratio. Current assets divided by current liabilities. So what happens to your current assets? What happens to your current assets? Your current assets comes down or goes up? What happens to your current assets? Current assets drops because inventory is current assets. So your current ratio goes down. It doesn't improve. It gets deteriorated. Can you give me an example of in efficiency ratios? Can you give me some examples of efficiency ratio? What ratio can you going to give me an example of efficiency ratio? Efficiency ratio. I want to think about your thought process. Why you answered efficiency is correct. A and C are wrong. So is that why? Okay. Inventory turnover. Super. Inventory turnover ratio. Or you want to talk about asset turnover ratio. Everywhere your inventory comes down, turnover is unchanged. Inventory comes down, the ratio goes up. How do you calculate this? Revenue divided by inventory. So inventory goes down, the ratio increases. Okay. Is that clear? Anybody who had a trouble figuring out what's going on? Is this helpful explanation? Inventory turnover. First understand what ratios goes in where. You don't need to know a list. Just know one ratio here and there that helps you to answer questions like this, isn't it? It's an interesting question. The correct answer for that is B. Okay, 106. Please send your answers, all of you. 106. PHI company has reversed a write-down of inventory. Reversed a write-down of inventory. Okay. PSI company uses the FIFO inventory cost method. It's an intelligent question. Which of these companies may be reporting under US GAAP? PHI company has reversed a write-down of inventory. PSI company uses the FIFO inventory cost method. Which of these companies may be reporting under US GAAP? May be reporting under US GAAP. Either of these companies, neither of these companies, none of these companies. What's the answer? Okay, let's talk about it. Okay, now if you are writing, if you are reversing impairment losses, reversing the losses, is it US GAAP or IFRS? Is it US GAAP or IFRS? First question. You are reversing the impairment losses, it is IFRS. Okay, so that is out. That is out. Okay, they cannot use, yeah, so you cannot use that. Okay, that's done. Okay, now PSC company uses the FIFO inventory method. So when you say FIFO inventory method, who can use FIFO inventory method? Can a US GAAP company use FIFO inventory method? Can a US GAAP company use? Yes, yes, of course. So that is why neither of these companies is correct, not correct. Only one of these companies, C, is the correct response. It's right because, this PSI could be US GAAP or IFRS. The trick here is, this is the very special about CFA questions. Think about it. I like this question, I told you, because there's a trick. By the time you know, okay, FIFO, you think, okay, FIFO is IFRS. If it is LIFO, you think it's US GAAP. So if it is not LIFO, FIFO is IFRS. That's the tendency of the brain, isn't it? So they want you to fall into that trap. But remember, in IFRS, in US GAAP, every damn thing is permitted when it comes to inventory valuation. So which means that FIFO inventory method is also permitted there. So one of those companies. So that's a good question. 106. The correct answer is C. Most of you have answered correctly. Okay. Now the next question is 108. Okay, that's a good one. 108. Look at 108. Okay, Story Incorporation uses a LIFO inventory cost method. Cost of sales for the year is 50,000. LIFO reserve at the year end is 6,000, increased by 2,000 year end. LIFO reserve increased. And the COGS under LIFO is given. They ask you to calculate FIFO COGS. They are giving you the LIFO COGS and they are asking you to calculate FIFO COGS. They have given you the LIFO reserve and the movement in LIFO reserve. What do you think is going on here? 108. All right, so again, so how do you calculate a FIFO inventory from LIFO inventories to start with? You take LIFO inventory and add the LIFO reserve, and that's going to give you FIFO inventory, isn't it? So here what's happening is LIFO reserve is actually increasing by 2,000. Okay, so what happens, your cost of sales, so when the LIFO inventory is increasing, means the FIFO inventory would be more. When the FIFO inventory is more, only remember one thing, whether adding or deducting, remember one formula. LIFO inventory plus FIFO plus the LIFO reserve will give you FIFO inventory. Okay, think about that logic. And then when you are given LIFO COGS, you add the changes in the LIFO reserve, that will give you FIFO COGS. Now it is increasing, LIFO reserve is increasing, so which means FIFO inventory will go up. When the inventory goes up, what happens to COGS? When the inventory goes up, what happens to COGS? COGS drops. That's a complex way of thinking. If you feel that way, go through the formulas. It is there in one slide. Remember, we talked about LIFO reserve. There's a one table, a rectangular table that was there in which talks about everything. FIFO reserve, LIFO reserve plus LIFO inventory will give you FIFO inventory, and LIFO COGS minus changes in LIFO reserve is LIFO FIFO COGS. So basically 50,000 minus 2,000 is 48,000 is the correct answer. If you have mathematically any issues, please raise it up. 108 is correct answer is A. I know you guys added it because you only remember that LIFO inventory plus LIFO reserve is FIFO inventory, but you didn't think about FIFO inventory is going up. When the inventory goes up, what happens to COGS? COGS reduce it. COGS will come down. Okay, look at this. That, I mean, you know, that takes me back to something else. Okay, look at this. I'm going to show you. Refer you to something here on the inventories. Look at this. There is a table on the inventories which, okay, look at this. Look at this. Look at this. This is very useful. Look at this. LIFO inventory plus LIFO reserve, FIFO inventory. LIFO COGS minus change in LIFO reserve is FIFO COGS. Go by this inventory formula if you want to go by formula, but I go by only this formula, and I would derive everything else myself, because if your LIFO reserve is increasing, you are adding to FIFO inventory, but the FIFO inventory is going up, means what happens? Your closing inventory going up in FIFO, that will reduce COGS, increase net income. I have all the answers, you know, decide which way you want to go. You want to go through these formulas, apply it, I'm happy with that. Or if you just want to know only one, derive everything from there. If you are that type of person, you know, I'm fine with either way. Yeah, so this is exactly what we are talking about. So going further back to the question pack. Wait a minute. Okay, the next question is going to be, okay, 113, question 113. 113. Under IFRS and under US GAAP, goodwill is subject to annual impairment review, but is not amortized and tested for impairment if there is an indication that the goodwill may be impaired, tested for impairment, and any impairment is amortized over the useful life of the goodwill. 113, what is the answer? Okay, I have received 3 answers, and basically all 3 answers are correctly stated except for one. I've received 1, 2, 3, 4. I think most of the answers have come. Guys, the correct answer is A, because goodwill is an intangible asset with infinite useful life. So you've got to carry out annual impairment testing. Remember this, any intangible asset with infinite useful life, like goodwill and renewable licenses, yeah, all of them will come in should never be amortized. If intangible assets in IFRS and US GAAP, you do not amortize intangible assets with infinite useful life. You test for impairment on an annual basis, amortize and tested for impairment if there is an indication that goodwill may be impaired. This is applicable for long-lived assets and other intangible assets, but not for infinite intangible assets. Tested for impairment, any impairment is amortized over the useful life of goodwill. It doesn't make sense at all. Complete rubbish. Statement C is completely incorrect. Okay, question 112. Look at 112. Question 112. Capitalizing rather than expensing an item is most likely to increase a firm's what? Capitalizing rather than expensing is in an item is most likely to increase It's a good question. Capitalizing rather than expensing an item is most likely to increase the firms. I got 3 answers so far and only 1 is correct. Okay, read the questions properly, guys. Capitalizing rather than expensing will most likely to increase a firm's what? Income variability. Remember, capitalizing, will it reduce income variability or increase income variability? Capitalizing, would it increase the income variability or decrease the income variability? Capitalizing, you are smoothing it because you are capitalizing and then you have amortized it. So you will have only amortization or depreciation. So remember, expensing would have high income variability. Capitalizing would decrease it. So that will not increase the variability, will decrease. Future net income, how would the capitalizing will increase? Capitalizing means your future depreciation is going to go up. If the depreciation goes up in the future, your net income is going to go down, isn't it? Do I make sense here? If you capitalize, if you expense, your current period profit comes down. If you capitalize, your current period profits will go up. But in the future, as you depreciate your assets, your net income comes down. And what you guys, some of you said B, why it says B? It's clearly not B. Cash flow from operations, that's exactly correct. Why? If you're capitalizing an asset, the payment that you make for the assets, which activity it is going to be in your cash flow statement? Cash flow from investment activities. There you go, Sati. So cash flow from investment activities means you have a capex outflow that's going to reduce the outflow. You're going to reduce, that's going to capitalizing means your investment activities cash flow is going to come down, but operating activities is going to go up because you're going to show this as an outflow in CFI. So your CFI will drop while CFO will be overstated. A great question. Only 2 people got this correct. So pay attention to these type of questions. You have any trouble understanding, go back to the mind map table. Or if you had been tired when I was explaining this portion today, go back and listen to that portion along with the slide. You will get that. You have to get this correct. This is a very important portion of the material. Right, so we are done with 113. Okay, the next question on the pipeline is 115. Great question. I like this question. 115. Pay attention to 115 now. Which of the following statements is least likely, least accurate regarding impairments under US GAAP? Which of the following statements is least accurate regarding impairments under US GAAP? The recoverability test compares the balance sheet value of the asset to the undiscounted cash flows from its use and the residual value. Impairment loss is the difference between an asset's carrying value and its market value, or the present value of the cash flows from its usage and residual value. If an impaired asset's fair value subsequently recovers, its carrying value may only be increased after the asset's historical cost. Which is least accurate? Which of question 115 is least accurate regarding asset impairment? It's a great question, testing a lot of stuff on asset impairments. Question 115. Okay, I got two answers and both of them are correct. I got three answers and all three are correct. It is least accurate, guys. Pay attention. It's least accurate. When you're doing an impairment testing in the US GAAP, first you compare the carrying value with undiscounted future cash flows of the company, isn't it? That's what you do. It's least accurate. Anyone else yet to answer this question, question 115? And we're yet to receive answers from a couple of people, so I'm still waiting. What's the answer? Question 115. I don't understand what's confusing here. Okay, I got one more answer. So still waiting from one person. That's right. So that's one more correct answer. What's the answer here? Question 115. Okay, is statement 1 correct in the US GAAP? In the US GAAP, this is what you do at the beginning to understand. You compare the balance sheet value of the asset with the undiscounted cash flows of the asset. Is that right? Is that what you do? Yes or no? That's what you do, isn't it? That's what you do. But how do you calculate the impairment losses in the US GAAP? You compare the carrying value with the market value. But if the market value is not available, fair value is not available, you can also use value in use. Remember, I told you, and that's why B is correct. And the third one is talking about what? Third one is talking about what it is talking about. Can someone tell me what the third one is talking about? And all of you answered this answer for this question. Can you tell me what this point is talking about? It's talking about what? It's a big sentence, but what is? It is the least accurate. Your answer is correct. What is this? This is impairment. What is this? Is a reversal of impairment. This is a reversal of impairment. Yes, there is no reversal of impairment in US GAAP, and that is why it is least likely to be correct. Okay, reversal is not permitted. 115. Okay, 117, guys. Okay, again an interesting question. I like this question. Look at this. Blaney Holdings has seen the market value of its property, plant, and equipment consistently increase over the last few years. Okay. Blaney reports under IFRS and chooses to revalue fixed assets. Revalue, it's allowed in US GAAP in IFRS, but not in US GAAP. Yeah, that's right. What are the most likely effect on return on equity and debt to equity ratio if PPE values continue to rise? Okay, good question. What happens? Question 117. What happens to return on equity? What happens to debt to equity ratio? What are you trying to do? You're actually trying to revalue the fixed assets. The value of your fixed assets is going to go up. You're going to revalue them. So what happens to your return on equity and what happens to your debt to equity ratio? It's a great question. Question 117. You can always write down the ratios if that helps. Initially I used to do that. It always helps you if you're unable to not frame that in your mind. Return on equity, how to calculate it, write it down. Net income divided by equity, debt to equity ratio, debt divided by equity. So then you can understand what's going to happen to these. What's going to happen to these things? Debt to equity is debt divided by equity, and return on equity is net income divided by equity. Okay, I got one correct answer so far. Anybody else wants to talk about question 117? What is the answer? Revaluing fixed assets. Think about the accounting entry. What happens when you revalue the assets? I've got 2 correct answers, 3 correct answers now. Anyone else? Okay, I've got 4 correct answers. Okay, think about now. I'm going to tell you. If you revalue fixed assets, what will happen? Where are you going to take the revaluation gains? Where are you going to take the revaluation gains? You are going to take the revaluation gains to? Where are you going to take the revaluation gains? You are going to take the revaluation gains, revaluation reserve, and that goes to your equity. So equity goes up and your profits doesn't change for the current year, but in the future profits go down because of higher depreciation after revaluation. The current year profit doesn't change, so your return on equity comes down because higher equity, higher denominator effect, return on equity comes down. Debt to equity ratio, debt divided by equity. Debt doesn't change, but equity goes up. So debt to equity ratio comes down. So the correct answer is lower C. Okay, so you guys got that right. Most of you got it correct, which is I'm fine with. Okay, question 119. Okay, I just have got 2 questions, guys, and then we are done. Okay, question 119. Given the following data for a company's property, plant, and equipment, you have a cost of 600 million. You have accumulated depreciation, the depreciation so far, and then you've got an annual depreciation of 50 million. Which of the following statement is least accurate? The estimated average age is 8 years. Remaining life is 2 years. Total useful life is 12 years. Given the following data for a company's property, plant, and equipment, which of the following statement is least accurate? Average age of the asset. Accumulated depreciation is the depreciation so far. Depreciation expense is the depreciation for the period. Remaining life, average life, total useful life. I got 2 answers so far, and 2 of them. I got 3 answers so far. All 3 are correct. cost, accumulated depreciation, and depreciation expense. Okay. Right, look at this question. How would you calculate the age of the asset? Age of the asset. How would you calculate the age of the asset? Okay. Age means the depreciation that is calculated so far. Where would you see the depreciation so far? The depreciation calculated so far, where would you see? No, depreciation calculated so far, meaning how many years is accumulated depreciation divided by annual depreciation. This is your annual depreciation, 50, and you have an accumulated depreciation of 400. So how many years it has taken for accumulated depreciation to build up to 400 if you have 50 million depreciation each year? If you have 50 million depreciation each year, it has taken 80 years. So 400 divided by 8 is 80 years, which is correct. That's average useful life. What is the total useful life of the asset? What is your annual depreciation? Cost divided by annual cost divided by annual depreciation. 600 divided by 50. That is 12 years. That is the total useful life. What is the remaining useful life then? How do you get it? How much is the carrying value of the asset? How much is the carrying value of the asset? 200. What is the annual depreciation? 200 is the carrying value of the asset. What is the annual depreciation? 50. So how many years you will depreciate the asset to fully depreciate? You will depreciate it for 4 years, isn't it? So remaining useful life is 4 years, not 2 years. So answer B is incorrect, least accurate. Right, question 119. So I'm going to look at 2 more questions as I told you. Okay. 120. 120. Which of the following statements most accurately describes the way deferred tax items should be used for your analysis? Which of the following statements most accurately describes the way deferred tax items should be used for analysis? Deferred tax liabilities that are expected to reverse in the future should be classified as liabilities. Deferred tax assets that are expected to reverse in the future should be reduced by a valuation allowance. If non-reversal of deferred tax assets, tax liabilities is likely, they should be classified as liabilities. All right, look at this. Deferred tax asset. What is deferred tax liabilities? You know, your liabilities that are going to be reversed in the future means that it's a timing difference. It's just telling you it's a timing difference, and in the future you'll have to pay more taxes. So that's why it's a deferred tax liability. It's going to get reversed, which means you are going to pay more taxes. That is correct. Deferred tax assets that are expected to reverse in the future should be reduced by a valuation allowance. Remember, deferred tax assets that are not expected to reverse in the future should be reduced by a valuation allowance. Yes or no? We are talking about deferred tax assets that are not expected to reverse in the future. What does that mean? If it's going to get reversed, then you are going to get the money. You are going to use your unused tax losses. You are going to fully claim that, isn't it? Deferred tax assets that are expected to reverse in the future. Why would you reduce that by a valuation allowance? If you are going to reverse it, you will reduce it by a valuation allowance when it is not expected to reverse. You are not going to receive them. Yeah. So the correct answer is basically A. If non-reversal of the deferred tax liability is likely, they should be classified as liabilities. That's not right. You don't have to even recognize that if there is no reversal happening. Okay, right. Question 124. Can you look at 124? Conservative accounting choices would result in current period of earnings that are conservative accounting policies would result in current period of earnings that are anyone else not answered yet? I think a couple of people not answered. I think everybody who have answered so far is actually right. Conservative accounting choices would result in current period earnings that are biased downwards, because you're conservative meaning that's exactly right. Conservative meaning you are increasing the expenses, decreasing the revenue, so you are reducing the net income. So the correct answer is B, and everybody answered that question correctly. I'm going to just give you one more question and then we are done. I'm going to show you one question and that's the last question. Okay, question 87 and 88 together. Okay, let's look at 87, 88 and then we are done. Sorry about that. Very interesting questions and it's easy to finish up fast. Question 87. Which of the following statements regarding component depreciation is most accurate? Component depreciation is required under US GAAP, is permitted under IFRS but seldom used, involves depreciating an asset based on the separate useful life of its components. Question 87. Got only one answer and that's right. 2 answers right, 3 answers right, 4 answers right, 5 answers right. Right, so that's 6 answers right, 7 answers right. All right, so that means component depreciation is permitted in both standards, but it is mandatory only in US, in IFRS, but not in US GAAP. So C is correct. It means you depreciate them separately. Okay, question 88, the last question for us today. In the context of deferred tax items, what is the impact on net income of an increase in the valuation allowance? This is, I tried so hard to explain this over and over again. So hope all of you get this right. Question 88. In the context of deferred tax items, what is the impact of net income of an increase in valuation allowance? One answer and that is correct. 2 answers, that is correct. 1 wrong answer. 2 wrong answers. Okay, another answer is correct. So I don't know how many got it correct. Okay, this is okay. 1 correct. Okay. Correct, correct, correct. Wrong, wrong. Okay, 2 answers is wrong, and except everything else is right. I mean, again, think about it. You are increasing the valuation allowance. If you increase the valuation allowance, what happened to your deferred tax assets? What happens to deferred tax assets if you increase the valuation allowance? Comes down. DTA decreases. If you are increasing the valuation allowance, your DTA decreases, isn't it? DTA decreases. If DTA decreases, what happens to your net income tax expense, your income tax expense, what happens? If your DTA decrease, what happens to your income tax expense? Your income tax expense, assets decreasing. Asset decreasing mean what happens to taxes? Taxes go up or come down? Taxes, deferred tax asset is increasing, decreasing because you are increasing the valuation allowance. So deferred tax assets is what? Deferred tax asset is your DTA, existing DTA minus valuation allowance. Okay, understand this. So this happens, your DTA increasing the valuation allowance, you are dropping the DTA. When the DTA drops, it's an asset which is falling down in value. So when an asset falls down in value, what happens? When an asset falls down in value, what happens to the asset? But what happens to the income taxes? Income taxes go up. Net income drops because DTA drops means income taxes increase, net income drops. In simple terms, if you don't want to even talk about income taxes, when your DTA increases, if your DTA increases, what happens? The DTA decreases. It's an asset decrease. Asset decrease is a write-off. Write-off is a cost. It will reduce your net income. So the correct answer is A. Is that right? Question 88. The correct answer is basically A, not B. All right. So that's great, and I see improved responses. I think most of you have got like kind of except for 2 or 1 or 2 wrong, and then you got everything else correct. It's kind of a great thing that you are on top for. But I would recommend you revise the mind maps wherever you are stuck. Go back and revise the revision slides, and then come back and try and revise. Do all these questions, go through the mind maps, go through all these questions, then you are on top 4. And as I told you, FRA and ethics are 2 important topics which accounts for 1/3 of your success, over 1/3 of your success in CFA Level I exam, and if not more, because of ethics adjustment in the exam. Right? If your MPS, let's say 66, that's around the MPS in CFA exam. So if your MPS is around 66, let's say if your marks is about 65, and if you are on the top notch on ethics, they pass you because they know they like you, they're fond of you because they know you know better ethics than the rest of the cohort. All right, so that's about it. Thank you for the extended session today. You know, FRA is difficult, it's very lengthy. Yeah, so let's meet up tomorrow morning, not at 8 a.m. but at 9 a.m. You know, let's what's the agenda for tomorrow? Let's have a look at the agenda for tomorrow. Let me open up the agenda. See what's the agenda for us tomorrow is basically we're going to look at equity and portfolio management in the morning, and then we are going to look at fixed income and derivatives in the evening. So that's what we are going to do: equity, portfolio management, fixed income, derivatives. I'll see you tomorrow at 9 a.m. and thank you for cooperation, and I'll see you, and all the very best. Yeah, we need to still do AI, so we'll somehow try and see how best we can cover it up. You know, I'm probably still thinking to do AI tomorrow evening with fixed income and put derivatives onto Wednesday with cons, right? Right, that's a good question. Considering the increasing COVID cases, will that affect the exam? For the moment, the best answer that I would give you is hopefully not. They have not yet announced anything. They have not told anything about it. But if you see most of the things that they are talking about at the moment in terms of restrictions that are being announced, what I'm seeing is they are restricting large scale gatherings and things like that. So if you already have approvals to conduct examination and things like that, I don't think that would affect. But if things go bad, if the restrictions are increased and things like that, you probably don't know what's going to happen. So hopefully not is probably my best answer, right? Uh, so I'll see you tomorrow morning at 9 a.m. Yeah, we all assume that the exam is happening and then we work towards, and the rest is, fingers crossed, right? Okay, guys, I'm going to see you morning at 9 a.m. with some interesting stuff on equity and portfolio management. And I think, in terms of, you really want to ask me FRA, equity, fixed income, and equity, fixed income, FRA, and corporate finance are the areas where I could really add value if you have already done your revision. So that's very important areas. All right. Good night, and I'm going to see you tomorrow morning. Thank you.